We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted last week. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app because then you can actually log in and ask us questions and interact with us as well. Just as a reminder, as always, you can find our podcast on Spotify, Apple Podcasts, and anywhere you want to listen to it, as well as Odysee if you don't enjoy using YouTube. I hope you enjoy it and hope to see you on the next one.
Hey, everyone. Welcome to another Fun Friday Spaces. Looking forward to getting Lee in here as well. Hear some of his thoughts. Anything on your mind this Friday afternoon, Bob, after this interesting week, to say the least?
About a fifth of Jack Daniels. No, this has been a roller coaster. Obviously, fielding a lot of questions, a lot of concerns, that type of thing. But there's certainly a lot to kind of come through here. It'd be nice to kind of have Lee kind of go through his sort of analysis, because he's done a very good job of calling the markets. He does a great job of laying out the story, and with a lot of data rather than conjecture, and it's a nice thing to kind of have, where someone that digs through all the folders and files and reports and that type of thing is able to kind of put it into more context. So it'd be nice to. It's one of the things I have a lot of appreciation for. Just does a wonderful job.
Mm-hmm. And especially when he's looking at it all the time. Yep. I think he's in here now. Hi, Lee.
Hey, Lee. Yeah, at the lower left-hand corner.
Okay, how about now?
Sounds good.
All right. Took me a few minutes.
How are you, Lee?
I'm doing okay. How are you guys?
Good.
Thanks for joining us.
Thank you.
Lee, one of the first things I wanted to ask you is the market celebrating the reappointment of Jerome Powell?
Oh, God forbid. Yeah, you probably saw my comment about that a little earlier today.
That's why I wanted to ask you.
I consider Powell and Bernanke financial war criminals, so to speak. Bernanke basically founded and Powell continued the support and promotion and enablement of this greatest financial moral hazard bubble in history. Is the market celebrating? I don't know. There's a lot of liquidity that's been pumped into the market the past few weeks from these treasury paydowns. And, eventually all that cash comes home to roost. And I guess today was the day they decided to put it to use. Maybe it was in celebration of the reappointment of the guy who has paid them, so well for the last 4 years, and the Fed in general for the last dozen years. I mean, they've made it easy for them, so I guess they have reason to celebrate. The rest of us don't, but they certainly do.
Lee, the one thing I was going to maybe have you, because I wanted to have you be able to tell your sort of how you analyze the markets, that type of thing, and you've kind of been calling this sort of bloodletting, in the stocks and bond market for a little bit of time here, kind of giving everyone sort of fair warning, and then oddly, with this income tax payment season and seasonality, right. Having the liquidity is going to come back in at some point here, and like you said, today could have been that perfect opportunity to kind pump the market up. Obviously the Fed tries to smash it, or they want to see the market get smashed to a low enough point that if the money starts coming in, it just doesn't reignite a bubble or push commodities back up. But maybe you could kind of talk about that a little bit, because some people may not follow your work completely.
Well, I guess a good starting point is the fact that there's been an enormous bulge in tax revenue the past few months and the past year. I mean, federal income tax withholding tax has been growing at a very, very rapid pace. I don't bother with any of the other economic data. The tax data tells me what's going on, and we've got a booming economy. We've got a bubble economy still. And the individual income tax collections were absolutely enormous in April. The Treasury general account built up to, again, near $1 trillion. And their target level is generally around $650 billion. That's the recommended level that the Treasury Borrowing Advisory Committee has suggested that they hold in reserve at all times. And they're over that. They got to a point where they were over that by $300 billion. So what they've been doing is week in and week out paying down Treasury bills. They've elected to continue to issue coupon paper. And there's net new issuance along those lines, along the coupon paper line, the bonds and notes, about $100 billion a month. But they're paying down about $40 billion a week in T-bills right now, and they still have a ways to go before they get down to $650 billion. So that $40 billion a week is sort of a quasi-QE that comes into the market, except that it isn't going into the accounts of the primary dealers. I mean, some of it is, but it appears that most of it is going into money market fund accounts. And that means that of that $40 billion a week that's coming in, most of it's not going to get spent to boost stock prices. Most of it's just going to go into the Fed's RRP slush fund, or money market fund of money market funds. And it's just sitting there and building up as these Treasury paydowns come in. So there's an immense amount of cash coming in. I was surprised that virtually none of it got deployed over the last month or so. The market has been actually quite a bit weaker than I expected it to be, although I had a lot of short sales recommendations out there. And, there's a lot of cash there, but it can only be committed to short-term paper, and only a small amount of it can be committed to stocks and bonds. So from time to time, we're going to get these spike rallies. That's how bear markets work. But I don't see them being sustained for very long. I don't know how long this one's going to last. But it'll burn out in a few days. We'll roll over and go down again.
Yeah, and that's a lot of people call for bottoms. They call for like the bond market. The last year and a half, you've had a lot of FinTwit guys talk about, hey, we're going to go back down to zero interest rates, and the bonds are the place to be, and we're all throwing up, hearing this crap, and the one thing you've been able to do is say, listen, if you look at the numbers, it's black and white. Where this thing is probably headed, and you've been nailing it. And yet all these guys with 100,000 followers plus are sitting there going, hey, buy bonds. And, you got the thing dropping 20%. And, these guys are losing people money. And I mean, longer term, we get these wiggles, but longer term, the bond market, like, you kind of have a different way of looking at this, because it's really just a numbers game, and it's really dictated by the government, what their need for paper is.
Well, I guess I have a very simplistic way of looking at things. I'm just a very simple-minded guy, and I learned a few things about economics and finance 50-some years ago when I was in college, and they stuck with me. But I learned a lot from the old traders that I used to sit with back in the customers gallery at Walston and Company and at 15th and Market Street in Philadelphia when I was a kid, and I first became interested in the market in the 1960s. And I'd sit with these guys, and they would keep repeating these things that I thought were stupid. They would say things like, don't fight the Fed, the trend is your friend. And, it's like, oh, I didn't think it meant anything. Then I realized later on in life that it meant everything. And those two rules are all you really need to know to get the market right. Don't fight the Fed, and the trend is your friend. And if you follow I call it rule number one, rule number two. If you follow rule number one, don't fight the Fed, then it's not hard to follow rule number two. The trend is your friend. And the trick is to recognize when the trend is changing and to identify those turning points and then just to ride it. And now we have a situation where the Fed is antithetical to a rising market. It is enacting policy that it wants to bring the markets down, and it's working. And the trend is confirming it. We have a consistent trend of lower highs and lower lows. Despite these rallies, they seem to be unable to exceed the last high. Now, we're going to get one along the way that's going to break a short-term high, but it won't break an intermediate high. And that, Joe Granville called that the rally that fools the majority. Everybody will come piling back in again. And maybe that started today, and we'll ride that too. We'll get long some stocks if this is sustainable on an intermediate swing basis. But I don't know how long it's going to last, but we're just going to track the charts, and when they roll over again, we'll get short again. But as far as the bond market's concerned, it's just very simple. Bond prices are determined like anything else by supply and demand. That's another simple concept that everybody forgets. And they make up all kinds of reasons and all kinds of narratives and stories about inflation this, deflation that. It's irrelevant. It's the amount of money versus the amount of treasury supply. And this is something that I explained to you, Tom, a while back. When the Fed was in QE mode, it was either directly buying or indirectly financing almost all of new treasury issuance. And when the Fed stopped doing that, prices had to fall because there's not enough intrinsic demand in the market without the Fed being a major buyer and the financier of everybody else to buy this paper that's coming. And as I said, the Treasury is still issuing coupon paper at 100, 150 billion a month. Market's got to absorb that, and it can't do it without the Fed buying most of it. So it's a simple fact that there's not enough money out there to absorb the notes and bonds that are being issued, along with all the equity that's being issued and corporate debt that's being issued. It used to be a one-way street with corporate buybacks and no new issuance. Well, now those things are in balance. There's probably more new issuance than there is buybacks now. So you have an excess of supply of financial assets and inadequate money, an inadequate amount of money, and soon to be even less money to absorb all the issuance. So prices have to come down. That's the way I see it.
And then with QT, I guess, the funny thing is this market's fallen out of bed and you haven't even had the balance sheet materially reduced yet. And so what do you kind of see, this whole market cry uncle? Because there's no way that if there's to support the debt issuance and obviously capitalization of companies and the financing of more debt from corporations and so forth, and of course with inflation staying, inflation will pull back certainly because we have our comparables from last year are probably going to start getting a little bit easier to at least on a month-to-month or year-to-year basis should be a little bit easier, but you still have rising costs. How far do you think the Fed can probably do QT without this whole thing sort of imploding? I
don't think it can last very long. I don't know. But, right now, the markets are having a tremendous amount of trouble just via the fact that the Fed's not a buyer. And actually, the Fed is still a buyer of MBS. And, these replacement purchases are real new money to primary dealers, but those replacement purchases of the MBS are diminishing rapidly also. And now, the Fed is going to actually start cutting and putting paper back into the market when it starts QT. I mean, the Fed's actually going to add supply treasury supply and MBS supply to the market. I don't think the market can bear that for very long at all. I think the Fed is going to be forced in a very short period of time to reevaluate, if not reverse course. I think it'll get out of control. Eventually, I don't think it will take long for these falling asset prices sometime this summer or fall to impact the economy. Obviously, they will at some point. And particularly if the real estate market seizes up, which I think it will. And so, these tax revenues can continue growing for a few more months, but eventually the economy will follow the financial markets. And as the economy starts to weaken and tax revenues start to weaken, that makes the problem even worse. And everything just kind of becomes a self-feeding negative feedback loop where you have financial asset prices falling, you have the Fed causing more treasury supply to be issued, then you begin to get a contraction in tax revenue, which requires even more treasury issuance, and you have less and less capacity in the market to absorb all this paper that's going to start hitting. So I don't think QT, quantitative tightening, or whatever you want to call it, the Fed actually reducing the size of its balance sheet and adding to treasury supply, I don't think it can last very long. But by then the market's going to crash, Bob.
Yeah, exactly. But that's where the question of the dollar. Obviously the dollar's strong right now because we're the cleanest shirt in the dirty laundry type of thing.
No, it has not. That's a bullshit. It's cleanest. We're not the cleanest shirt. It's because the Fed has stopped issuing dollars, and the ECB and the Bank of Japan are still issuing their own currency. They're still creating more euros and yen and whatever. So you have a relative difference in the world currency market between the supply of dollars and the supply of euros. There are fewer dollars and more euros. And so the euro is crashing against the dollar. The dollar is going up in price against all other currencies simply because there are fewer and fewer dollars. They're becoming more, their prices are rising against these other currencies that are still being printed. So is it just kind of the function, Lee, of everybody kind of running to the safety of the dollar at this point? Or just maybe not the relative safety or that reflex of running to dollars? Again, I'm very simplistic in the way I look at this, and it's a supply issue. And when the Fed and the ECB were both creating dollars and euros at the same rate, the dollar euro pair was pretty stable. And there was a period of time when the Fed was printing more than the ECB, and the dollar fell against the euro. So it's just, to me, it's the rate at which the particular central bank is creating new cash, new money, versus the other one or the other ones. And right now, the Fed is the tightest. It might not be the cleanest shirt in the laundry, but it's the tightest. They're just not making, they say, well, they're not making any more land. They're not making any more dollars right now. And the ECB is still making more euros. So the price of the dollar must go up against the euro. And I'm doing great. I live in Europe and I earn my income in dollars, but it's scary seeing this stuff go on.
Well, it's also important to note that as you have less dollars in circulation, the idea that we're going to actually be able to fund our deficit or debts, or you see that it's asinine to think that the bond market is the safest place to be, because there's no way in hell we'll ever pay this stuff back.
Bond prices have to continue to decline. And again, as you said, Bob, when they actually start to pull more money, withdraw more money from the banking system, which they're threatening to do at a rate of $95 billion a month, the implications of that, to me, are catastrophic in terms of bond prices and stock prices and maybe everything else. maybe they'll get consumer inflation under control, but by then, the system will be crap. I don't know how they recover from that.
Well, that's why I own gold and silver, because I think the only way they can recover is by, turning on the fire hose.
Yeah, relatively speaking, gold will probably do better and everything else, but that doesn't mean it won't go down. Might just not go down as much as everything else. But your purchasing power will improve. Assuming that consumer prices eventually give up the ghost as well, which they should eventually. I mean, obviously, if they continue this policy of removing money from the system, then it will at some point impact consumer prices, but it won't impact the CPI. Okay, initially, because the way the CPI is structured, there's a built-in lag with the housing price problem, and that means that the CPI is going, even after inflation begins to come down. And it drops from the current print of 8.5%, which is BS. It's much higher than that. As that starts to come down, in reality, the CPI is actually going to start overstating inflation, and then the Fed's going to have another problem. So,
Lee, how did you mentioned the housing market kind of seizing up and really throwing a wrench into things? How does that relate, or does that relate to the amount of MBS that the Fed is going to be issuing as well?
Well, yeah, I mean, they're going to be allowing these MBS to roll off their balance sheet, so there's going to be more issuance of MBS that the market will need to absorb. But the bottom line is that the mortgage rates are indexed to the 10-year yield. And as the 10-year yield rises, mortgage rates are going to rise, and affordability is going to become more and more impossible. But the other impact that'll have that a lot of people don't think about is that, old fogies like me who held on to their real estate because, we were getting no return on savings. Okay, there's a lot of people that don't want to be in the stock market. They want to put their money in the bank and get interest like in the good old days. So instead, if the interest rate is zero and you're going to sell your house and get zero on it, well, you don't sell your house. You keep it. Maybe you rent it to somebody and get a nice rental income. These suppressed interest rates, this interest rate subsidy that the Fed's been paying all these years, has kept inventory off the market. Now, when you start getting to reasonable interest rates, reasonable bond yields, 4, 5, 6%, the housing inventory is going to come out of the woodwork. And at the same time, nobody's going to be able to afford houses at the prices that we've been seeing them. So we're going to get another crack in house prices like we got in 2008, 2009. We were in suspended animation for a couple of years up there and had no market. The market just dried up. But house prices will come down at some point. And, just everything can go wrong. You just have all kinds of asset price deflation. The deflationists are right about asset prices. Eventually, they'll be right about consumer prices. But that's a secondary issue. That comes after the fact. That comes after financial assets have crashed. So if you're long bonds, you won't have any money. You'll be wiped out, especially if you're leveraged. You really won't.
I think, and that's a great point, because a lot of people, especially in the hedge fund industry, Wall Street, and the retail for that matter, have used leverage. Obviously, they've been the past few years it's been paying to borrow money to buy assets, but now we're potentially in this kind of cyclical or secular bear market that could really wipe people out. We haven't seen really a bear market. I don't know if you count 2 weeks in 2020 a bear market, but a sustained bear market. You've seen a number of those over the years.
Yeah, I mean, I grew up in the 72 to 74 bear market, and I definitely remember the couple of bear markets in the late 1960s and the 2000, 2003 bear market and the 2008 2007 to 2009 bear market. Those are real bear markets. And, this thing could easily shave 50% or more off of the asset prices that were reached at the tops. And bonds, I expect to do much worse. The Fed has to basically keep its foot on the brakes until the CPI really starts to moderate. And we really haven't seen any of that yet. And where is moderation to them? Is it 5%? Do they have to get back to the 2% target? Oh my God, if they try to drive CPI down to 2%, I can't imagine what the repercussions will be. I mean, really, we are in uncharted waters, my friend. Anybody that's predicting what's going to happen, I don't know how they can predict. All I want to do is get the trend right and ride the trend correctly. And if that means being short stocks is the only way to do it, or short bonds, I'm not somebody that knows about shorting bonds. So, you could short the futures, I guess, but I'm not into that. I don't like leverage, and leverage kills when you're wrong. And, these guys that make billions when the leverage is in their favor, great. But then they lose it all overnight and they disappear and they have your money.
Kind of like Luna with that stable coin. So one of the things that I look at is understanding, in order for debt servicing to maintain itself with the government or the economy, you need dollars. You're going to need to ultimately print,
yes,
or create more supply of it to keep the gears loosened and from the economy seizing up. And that's one of the reasons why the way I look at it is gold and silver are sort of this precious metals. It's more of a monetary thing than it is a chaos event. But it's the idea that they're going to have to print money, even though the economy may be collapsing or receding, or financial assets are receding, but they almost have to do it just to maintain asset prices to some degree. Otherwise, this whole thing just comes in, coming down like a ton of bricks. Is that, anything that's almost tied to debt or leverage, I think is at risk. Whereas from a monetary standpoint, gold could be the king of currencies again at some point. I mean, does that make sense to you at all? Or
whether gold is a currency, which I disagree, or a good money substitute, which I would agree. They're going to have to start printing again. There's no question about that. Either that, or they're just going to be willing to go to a complete reset. And God knows what kinds of governments we would be living under in those circumstances. What kind of social disorder we would be living under. I don't know how the Fed and the economic policymakers and the politicians can wiggle out of this. I think they've boxed themselves and us into such a deep corner that there's just no way out without an immense dislocation along many fronts. So I think there's going to be a lot of so-called wealth. It's fictitious wealth. It's just going to disappear.
Yeah, there's no liquidity under the surface. It may look good at the surface. The Fed's RRP, and you've touched on this a lot, and it's stubbornly staying very, very high.
Yes.
And what is your take with that?
Well, you know what? I expected it to stabilize at some level, and I said that is going to be the signal that things are about to get very, very bad, because it means that money managers just are sitting on their hands and the cavalry is not coming to the rescue. What I did not expect initially was that it would happen at the very top of the RRP holdings. I thought they would come down a little, that some of this would be spent to help absorb the bond issuance, but it's not. And as I mentioned that the Treasury is paying down now about $40 billion a week in T-bills. Okay. So who holds these T-bills? Well, government money market funds, and to some extent banks, and lesser extent primary dealers, and a much lesser extent the public. But it's mostly money market funds. So when if you're a money market fund manager and you hold billions of T-bills, and this week the Treasury tells you, well, we're going to redeem $1 billion of your T-bills. Here's your cash, Mr. Money Manager. What do? Well, you are now enabled to go to the Fed and say, oh, here, I have $1 billion in cash. Give me some Fed RRPs for my $1 billion in cash and pay me a little interest while you're at it. Okay. So the RRPs become a substitute to these money market funds for holding treasuries. And it's even better than treasuries because with the Fed, there is no risk. Okay. The Fed, unless the Fed says to them, okay, we're shutting down this RRP program. You got to put this money back into the market. Well, then, they could do that too. I mean, that's one way they could probably force money back into the market. The Fed could say, okay, we're going to start limiting the size of the nightly RRP auctions. And that would force these money managers to put the money back into the paper. But if there are no treasury bills to be had, and if they are limited by law in terms of what they are allowed to invest in, then they simply have to hold cash. Now, can the banks reroute that cash towards, longer term paper? Maybe. Yeah. And then you start to see bond yields coming down a little, but we're not even, this is pure speculation. We're not there yet. Right now, all I know is that the RRPs continue to rise dollar for dollar with the treasury pay downs as these money market funds have nowhere else to go. And at the same time, they can't redeploy it into bonds and stocks because they're just not allowed. So the money that I thought was going to be available to help support securities prices isn't. That's the bottom line.
Yeah, and I that's to me that's it's pretty telling because if they did end this RRP, it would send. I mean, it could send a lot of cash coming back in, but it would be like a tsunami trying to buy anything it could find.
Well, they won't do it all at once. They'll do it little by little. They'll start limiting the size. Right now the size is unlimited. So every night they do one. Now they're up to 1.8, 1.9 trillion in overnight repos. Well, the Fed could say, well, we're going to limit this now to 1.6 trillion. And next week we're going to limit it to 1.5 and so on. So little by little, they can force money back into the banking system. And don't forget, the Treasury will start issuing T-bills again once they get down to $650 billion in cash. And they still have a deficit, there's going to be treasury bills to absorb this. So, and at that point, the Fed's going to have to start limiting that, or you're going to see interest rates go right through the roof, just through the roof.
Well, and you've kind of said it best. This becomes a slush fund in a way to kind of to support the market when either liquidity starts to tighten up or the Treasury starts pumping out more debt, I guess you could say, or more treasuries. Yeah,
I thought it would be a slush fund to help support stocks and bonds. What I didn't understand was how much of this, because the Fed doesn't tell us yet. They say, oh, we're going to tell you who's participating in these RRPs. Well, as it turns out, you can tell just by the fact that the money is just sitting there and going up dollar for dollar with the T-bills pay downs. You can tell that it's almost all money market funds. They're the only ones using this. So, this thing will continue to grow as long as the pay downs continue. Now, I think they probably have about $250 billion left to spend paying down treasury bills. And do the math at $40 billion a week. What's that? Eight more weeks, or 6 more weeks. I don't know. 6 times 4, 24. It's at some point there in July maybe the Treasury will start net issuance of T-bills again, and that will start to suck money out of this RRP account. But it turns out it wasn't a slush fund. It was just a money market fund that the Fed set up for the money market funds, and they're not using it to buy stocks and bonds.
Yeah. Now, one thing also that a lot of people don't understand, is QE. Yeah. I mean, it's a very confusing topic. You've done a wonderful job of trying to explain it. People say it's not printing money. Yeah. It's
of course it is.
Yeah. Could you kind of walk through that? Because that I think is sort of a hot topic because when they start, they try to pull
hot
money.
Topic is still who the hell cares if they're not doing it anymore? Why is it a hot
Right.
topic? It's done. It's over. It's finished. You should be worried about them shrinking the balance sheet and pulling money out of the system at this point.
Right.
QE is history. It's over. It's finished. They can argue about it all they want. What would you like to know specifically?
Well, the question would be is when this QT starts and the bloodletting begins, maybe this RRP is used as a vehicle to try and add liquidity or try to support the T-bill market. But at some point, and it's dependent upon the economy and tax receipts. There's a lot of things, and the primary dealers, how leveraged those guys are. And then you got the banks with holding all these bonds that have been just getting slaughtered,
and they're not marked to market.
Right. That's a lot. So at some point, let's just say, like you were mentioning, maybe the fall, everything hits the fan, and now it's the moment of Jesus, and they're like, we gotta liquefy the system again, or something happens. Just the idea, because most people, a lot of people on FinTwit says, well, God, if it's a reserve, it can't be spent. It's not pretty money. It's they look at the technicality and theoretical.
That's wrong. It's not right. It's a reserve. It's not printing money. That's just dead wrong. Of course, it's printing money. Yeah. Do you want me to explain that?
Yeah, okay. I think it would help people.
Okay, look. When the Fed was doing QE, it bought. It did this through permanent open market operations. That's what it's called technically. What is a permanent open market operation? It is the Fed doing a trade with a primary dealer. So in the case of Treasury POMO, the Fed bought Treasury bonds and notes from primary dealers. Okay, it paid for that. The primary dealer has an account at the Fed, just like you have a brokerage account, and a bank account. They have one account at the Fed. It's a bank and brokerage account. So when the Fed buys these bonds from the dealer, it creates a deposit in the dealer's account to pay for the bonds. Where did that money come from? It came from the Fed's imagination. All the Fed has to do is wave its magic wand and say, poof, here's the money. This money, this $1 billion that I'm paying you for these bonds that I'm buying, that came from our imagination. And now it is real money for you, Mr. Dealer, to go ahead and use to buy other securities. And some of those other securities are you're going to buy more treasuries. So when you buy more treasuries or you buy other securities, that's a cash asset to you. Yes, it's a deposit on the Fed's balance sheet, but it's a cash asset to the person that gets the money. So it goes immediately it doesn't go immediately. There's a step. First, it goes into the dealer's account. Then the dealer does trades with other counterparties, acquiring more assets, and it pays those counterparties from which it bought that paper, and they get deposits in their bank accounts, thereby increasing reserves. But at the same time, it's a cash asset to them. They can go ahead and spend it. It exists. It's a double entry bookkeeping. And anybody who's trading and has had accounting 101 should understand it's an asset to the person holding the cash. It's a liability to the Federal Reserve. But just because you call it reserves doesn't mean that it's not moving around in the banking system and not being spent. It is. And the U.S. Treasury also gets money from those dealers the next week. The dealers buy more paper from the Treasury, and then the Treasury spends that money into the banking system, and it circulates freely. So the money exists as two entries. It exists as an asset in your account, my account, the accounts of the dealers, the accounts of all the other traders out there, and anybody who's transacting business with a bank. That money exists there and can be spent freely. And then it exists as a liability on the Fed's balance sheet in what they call other deposits held by depository institutions. And there are other line items in that liability side that are as good as cash also, but technically they're not counted. The economists don't count them as reserves. So like the RRPs don't count as reserves. Yet they're overnight money. They can be spent tomorrow. So why aren't they counted as reserves? I don't know. Got off the
No, I appreciate. Maybe if anyone has questions, I think Happy has a question.
Yeah, Happy's been waiting patiently. We had another one here that I can get to because it got sent to me.
Yeah, no, I was going to ask a while ago about the reverse repo situation, which you guys talked about fairly extensively. But I guess on that note, if you're expecting the bond market to really sell off hard, how much ammo does the Fed have in that 1.8 trillion reverse repo to support the bond market? And then also, it sounds like we're all expecting them to reverse at some point. So how far do you think the bond market would fall before they reverse or send in the reverse repo?
Well, I don't know. My job as a technical analyst is to just ride the trend, and the trend is down. And I got bearish on bonds in August of 2020 when they turned. And it became more and more clear that this was going to get worse as the Fed reversed course on QE. That what I expected was that the reverse repo fund would be used to support bond prices and stock prices, but it has not been because, as it turns out, and the Fed hasn't confirmed this yet, but it's obvious from the way it's behaving that most of the holders of the RRPs are money market funds. They are not allowed to buy bonds. They cannot buy bonds. So the money cannot be used to support stock and bond prices. I don't think the Fed can continue doing what it's doing, and I certainly don't think it can continue QT for very long because the bond market will come unglued. And how much pain is the Fed willing to accept? I don't know. We just have to ride the trend. And when the technical indicators begin to reverse and the Fed begins to make noise, the Fed's going to telegraph. Normally it'll telegraph. I mean, if it's a severe enough emergency, they'll spring a surprise on us and everything will turn. But, in the pandemic panic, it took 8 days for the market to turn once the Fed started flooding the system with liquidity. And that's unusual because normally it turns on a dime. And 8 days, if it turns into 10 or 12 days at the rate that things could go down, it may not be recoverable. So, Bob, I think maybe you're right that you need to have some gold to kind of cushion whatever's going to happen.
If I can help a little bit with the background, can you hear me okay, Bob?
Yep, sounds good, Jim.
Okay, thanks. When we were younger, passbook savings accounts were 4.5, 5.
Yeah.
If you got a CD at the bank, let's say a 5-year CD at the bank, you got 7. Sometimes you got 8. Well, now the 30-year bond, there's bills, notes, and bonds. That's the denomination. That's what they're called.
Yeah.
The 30-year bond today is 3%. Okay. According to what Lee is saying, and I 100% agree with him, the market will help. The public will help when the interest rates go back more in favor.
Right.
But for the last 30 years, one whole class of savers has been obliterated.
That's right.
And those are grandmas and grandpas that used to put their money in the bank and live off the interest. Now grandma and grandpa has to withdraw principal because prices are up and rates are down. Someday the rates will come back again. I'm not sure when, but I think that the demand will come back with money market funds and intermediate bond funds. Intermediates are 10 to 20, and then long-term bond funds, but not at 3. I'm not lending my money to the government at 3, but I might at 8 or 9.
Right.
Something like that. Go ahead.
Yeah, I agree with you. That's perfectly said. I am 100% in agreement with that.
And the way it works, it's like a teeter-totter that Lee understands. I hope everybody else does. But if I can simplify, it's a teeter-totter. And in the middle, let's say in the middle today, they're perfectly balanced at 3% for the 30-year bond. As the price falls, the rate goes up, or vice versa. And the reason it does that is because if the rate goes to 4, all of a sudden the bond that's yielding 3 today is worth less than the current bond that today you can get 4% for. Mm-hmm. So they balance that with the price of the bond. And in my business, in the futures business, It's real easy to see. It's about a 8-point difference per 1% of interest up or down in the bonds at this rate. So at 3%, the coupons aren't 3, the coupons are 6, let's say, but you pay a premium, okay? Or you get a discount. And at some point, the bonds are going to be discount to where they are today as the price of money starts increasing in price. And what I started saying is, as the interest rate, as the price of money, the rate of interest starts increasing, more and more people may be willing to lend their money to the government. That's the demand side. The supply side is such that since 2009, we elected a president, I think it was the 44th president of the United States. The balance sheet was around 9 trillion. Now it's about 30 trillion, might be a little over 30 trillion. And that's the supply side. And what that tells me, it's not the president, it's the president, what his wishes are in conjunction with the Congress that set the budget. So there's plenty of supply that could swamp this thing. And the demand right now has been the Federal Reserve. And the Federal Reserve sounds like they're intent on stepping back a little bit. I'll stop now for a while.
Yeah, I mean, the Fed's mandate is to control inflation, and they haven't done it. They've created inflation. It took a while, but when Powell panicked and started this immense balance sheet expansion in the pandemic panic, he created a spike in the money supply that the popular inflation indicators followed about 6 months later, and they always do. They follow the monetary aggregates, with a lag, and this is what happened. The Fed did this. Now, the Congress enacted all of these programs, these rescue programs for the pandemic, and spent $1.5 trillion. So the Fed basically made the decision that rather than allow bond yields to rise and the federal government to pay more in interest for these things, the Fed decided we're going to print all of this money instead of making the government and the taxpayers pay for it. We're going to print it. And that's why we have this inflation. So now, and Milton Friedman said it, if the money supply increases faster than productivity, you have to get inflation. Well, the economists and the central bankers kind of conveniently forgot about Milton Friedman's rule. And, Friedman was one of the few things he was right about. We got plenty of consumer price inflation now. And the Fed has a legal mandate to control it. So the Fed's between a rock and a hard place now. It's legally required to control inflation. And the only way it can do that is by restricting money growth. And if it restricts money growth, it can't fund the deficit itself. The public has to fund it, and the public ain't going to fund it at this price because it doesn't have the money. So bond prices are going to come down, bond yields are going to rise, and eventually we'll get to equilibrium. But the pain, there's so much leverage in the system. I mean, there's going to be so much of this leverage that's going to be wiped out, and this fictitious wealth that's going to be destroyed as it is in the cryptocurrency market right now. It's just hard to imagine the system staying stable under these circumstances.
One more thing in support of what Lee is saying, he's talking about the supply. The demand is also following, folks, from foreign countries. Foreign countries now, we've got a few major foreign countries that are mad at us that used to buy treasuries. And some of those foreign countries have been selling some treasuries. So that's adding more supply back into a smaller or a lighter demand market with the Fed out. And one of those might be China, one of them might be Russia. And we'll see. We'll see what else happens.
Yeah, I think that's, if it's true, and I don't know whether it is or not, I haven't seen evidence of it in tracking of foreign central bank holdings. They've been kind of stable. I mean, they're not adding like they used to. I mean, they used to drive things pretty well. The Fed has been the whole ball game, and I think that's where our focus needs to be. They've made this mess. The Fed is responsible for this mess, and I don't think they can get us out of it.
Lee, when we think about the importance of CPI and what that, let's say, signals to the Fed, this is a year-over-year comparison, right? So if actual prices stop growing because of some, let's say, demand destruction or whatever cause you want to put on it, while asset prices and consumer prices remain at a high level, that year-over-year comparison could start to drop off. Where do you see that happening? Like, do you think that's something that the Fed is going to be able to point to, that saying, oh, our rate hikes have started to have some effect here?
The Fed is great at making excuses. So whatever, again, to me, the inflation's irrelevant. The CPI is irrelevant. First of all, it understates inflation because of the way it counts housing, which it doesn't count. And it's just the supply and demand factors. At what point will the Fed stop QT? And I don't know. But if you begin to get a moderation in inflation, and in the CPI, I should say, in the published data, if that begins to moderate for whatever reason, what does that give the Fed an excuse to start easing again? And it will at some point, but how much pain will we have to endure? That's the question. I think the crash, which has barely started, we're in the early days of a crash here, and we may get a counter trend severe bounce before it resumes. But that crash is, I believe, underway. It's going to happen. It's going to play out. And at some point, the Fed will react. But I don't know when that is. And I don't know what their rationale will be. But I know they'll have a good excuse. They always have a good excuse. And Wall Street will just lap it up. And the politicians will lap it up. And they'll reappoint boobs like Jerome Powell, who basically do the bidding of the cronies that run the system, the bankers that get rewarded regardless of their malfeasance. So, everybody will cheer Bernanke, who is a financial war criminal in my mind, and Powell, and the Fed will make excuses. I mean, the self-exculpation, this is the thing the central bankers are best at, self-exculpation. And they'll find a reason, and it might well be some kind of moderation in the consumer price index. How much, I don't know.
So we had a question here earlier from Good Texture that was trying to be patient here. He said the question nobody seems to be asking: what are the chances that the U.S. Fed will raise interest rates rapidly to collapse the economy on purpose, 9/11 demolition style?
Interest rates are not what people think they are. Interest rates are the meter of monetary tightness or looseness. And the fact of the money supply is what matters. The fact of the Fed literally contracting the amount of money in the system is what matters. Money rates have been rising way ahead of the Fed. If you track the 13-week bill is one of the most sensitive interest rates. And if you track that, if you chart that, as I've been doing and showing, the 13-week bill rate is way ahead of the Fed. So the Fed just uses the Fed funds, the FOMC circus every 6 weeks, raising the Fed funds rate as a rubber stamp to the decision that they've already made to tighten money. Okay, how much the interest rate goes up is simply an artifact of how tight money is. They don't control the interest rate as a tool to tighten money. Okay, they tighten money, and interest rates reflect monetary tightness. Paul Volcker tightened the money supply. Interest rates went through the roof, okay, and the economy got crushed. That's how it works. And, when interest rates become punitive, become so positive that they're punitive, yeah, that has an impact, but it's merely a reflection of the monetary tightness, of the control of the supply, of the size of the Fed's balance sheet, and the amount of money that's being put into the system versus the demand for credit. So it's the supply and demand for credit that matter. Interest rates are the meter of that, and they are secondary. They are secondary. They are not the controlling factor.
Mm-hmm. Happy, you had another question?
Yeah, I guess we were talking earlier about the spiraling interest on the debt as rates go up. And couldn't the Fed argue that by keeping interest rates down and preventing that debt spiral from happening, basically doing financial repression, that they are actually controlling inflation by preventing that spiral from happening where the interest rates go up, so then we have to borrow more, which causes them to go up even more, and you end up in an even worse situation in the long run. So, why wouldn't they just do a ton of QE and use financial repression, as Lynn Alden likes to talk about a lot, as they did following World War II, and basically just inflate our way out of it rather than letting the bond market collapse.
I don't know what they're going to do. I just wait until they tell us. I wait until the Fed tells us what they're going to do, and then they do it. In the old days, they just did it, and we had to figure out what they were doing. Now they tell us in advance what they're going to do. Does the market front run that? Maybe a little bit. But the real impact doesn't happen until the Fed actually does what it said it's going to do, or does something that maybe they didn't tell us about, but they do it. And once the Fed does it, that's when the market reacts. I don't feel a need to anticipate what the Fed may or may not do because of this, that, or the other thing, because the market follows the money. The market prices simply follow the money. And if we follow the money closely enough, we watch what the Fed is doing and respond to what they do, that'll be plenty of time. We don't have to figure out in advance what they may or may not do. That's the way I see it.
One other thing, Happy, is that if we would have had some sort of moral conscience in the Congress where the spending would have gone down with these lower interest rates, they could have reduced the deficit a lot. But since 2009 at $9 trillion, it's $30 trillion.
It wasn't just the spending, my friend. It was the tax cut.
Well,
the tax cut had played a larger role in expanding the deficit prior to the pandemic. Now, the pandemic spending obviously had an enormous impact, but before that, the tax cut had the impact. We need to, if we decide we want to have programs to support the military or social services or whatever, then we need to pay for them. And the attitude of Congress has been, we're not going to pay for them because we're not going to raise taxes. So, it's not just a spending problem, it's a taxing and spending problem. There's moral hazard everywhere.
I would agree with part of that, but when the taxes get cut, the capital gains tax revenues increase. John F. Kennedy said that, Donald Trump said that, and it seems to work out. The only thing is the Congress on their spending side, I'm trying to, answer a little bit to Happy's question. They had a real chance here to reduce the deficit, and instead they just spent. And part of it is with some of these programs, this PPP programs, things like that, where they sent money, forgivable money to businesses to maintain their employees. Part of that can be argued that was just money thrown away. And it just added $4 trillion, I believe it was.
No, that's not correct. That's not correct.
In the last,
it wasn't that program was nowhere near $4 trillion. The total spending was $1.5 trillion. Yeah,
just that. Yes, but with the others, it got it up to near $4 trillion.
That's not correct. I mean, first of all, to get into the argument about the politics, I think misses the point of we're here to talk about investment strategy. The politics are what they are. I can't do anything about the politics. Neither can you. And, they're going to spend and they're not going to tax, and we're not going to have a balanced budget under any circumstances. So we can complain about it all we want. It's not going to matter. We have to invest according to what the reality is.
I agree with that.
Yeah.
Lee, we have another question here from you or for you. Omar wanted to ask you thoughts on the following theory and how it could practically work. Fed hikes 50 basis points in June and or July.
Right.
Then it pauses due to sharply deteriorating economic data,
Right.
but decides to continue QT. This way, it would be creating bidders for the assets.
Doesn't work that way. It doesn't work that way. Again, the interest rates are the meter, or the price of money that are determined by the supply of money versus the demand for it. So the Fed cannot independently say, well, interest rates are going to be this unless it changes the monetary policy. It just has to follow the market. It can't say, oh, this is going to be the interest rate unless it literally puts more money. So we're going to lower the interest rate. The only way to do that is put more money into the system.
Bill, you had a question?
Yes, thanks for hosting this, Tom. Love your show, and had a couple observations this week that I would like to see some thoughts from the group here. Is the first one is you had a gentleman on your show a couple months ago by the name of Christopher Aaron, who was a former CIA contractor and was also made some astute observations regarding cryptos versus the silver market, especially junior silvers. As a longtime silver investor, and I thought he was really onto something. And watching observing the markets, both crypto and silver this week, I think something has changed. And what has changed, at least in my opinion, is that now with the rug pulls that happened this week, the canceling of crypto trades on a very well-known exchange this week, I think there's a whole class of investors that are in the process of giving up on crypto and coming back to really what is the homeland of speculation, which is, precious metals, but more specifically silver and its related equities. And I wondered what your thoughts might be, as well as Lee's thoughts on this, and as well as Bob had any weigh in on whether this theory might hold some water.
If I could just maybe defer to Lee, because Lee could probably talk about how this deleveraging or this liquidity that's been taken out of the system, even though the Fed's balance sheet's still sitting close to $9 trillion, you've seen money being removed from the system, and how that has actually affected a lot of these, whether it's crypto or the bond market or the stock market. Lee does a good job of trying to track, the liquidity flow and how that affects, the markets and the systems and that type of thing.
Relative to silver, Bob, I just can't say. I'm not a precious metals guy in terms of the fundamentals of gold and silver. But obviously, if the crypto holders are getting slaughtered, they're not going to have a lot of capital to put into precious metals speculation at this point. And frankly, I think that the prices of all assets have to come down. But relatively speaking, I think you make a good case for the precious metals holding up better than other things. And cash will hold up even better, but it will still lose value versus its purchasing power. It's just a question of how much value it will lose relative to other things. And the only way, I think, to be on the right side of this immense bear market that we're likely to be in the throes of is to be short. To play anything from the long side, I think is probably not the right way to think about it. And you have to look for things that are going to get clobbered and things to short. And there are some very good short selling services out there that probably do a good job of that. And I don't want to mention any names. I mean, I do a weekly report on swing trade. It's a mechanical screening system where I screen 10,000 stocks on the New York Stock Exchange, the NASDAQ, and come up with some stocks to trade, on a weekly or 2 week or 3 week basis. And most of them have been on the short side for the last month. And that's worked out pretty well. I don't know whether silver is going to be an asset play that the crypto people are going to move into. I think the crypto bros are a whole different genre. I think they're a different genre. I mean, I'm an old guy. I don't know from crypto from nothing. I just felt like it was, they just don't have any value. There's an infinite supply of cryptos. I mean, maybe the supply of one type of crypto is limited. Bitcoin is limited to how much can be mined. But, every week they were throwing more and more new cryptos onto the market. So you have an infinite supply of crypto. And obviously demand isn't infinite. And a lot of it was speculative, leveraged crap that people were using their credit cards on. And, now it's all gone. The money's gone. With Bitcoin down 30 or 50%, whatever, from its highs, and probably going a lot lower, and some of these other secondary names getting destroyed, I honestly don't see that money moving into precious metals. I think it's a different, precious metals people tend to be a little more conservative and risk averse, and these crypto people, they're a different ilk, a different type of person, and I'm just not qualified to judge them.
Yeah, I would agree with that. The only caveat I would just say to that would be is that being familiar with the type of people who speculate in I would say junior miners to some of the more volatile miners, even though they're not necessarily juniors. That mindset, I saw a little bit of crossover with the silver squeeze last year, and kind of the folks who are momentum players who want to move into something, and that kind of is I'd like you to comment on that. But I also have one more comment before I let you go. Do you see the market that's right in front of us becoming more bifurcated in the sense of commodities seem to be in a clear and well-developed uptrend after a decade of laying on the floor? And different commodities are moving at different times. But do you see a more bifurcated market where there will be longs in the commodity area as well as shorts in the general equities / tech area? Thanks so much.
Well, I track the miners on a technical analysis basis, and I do a weekly report on again, swing trades in the miners, and I track about 52 of those, and I don't short them. Basically, I'm looking to buy them for these pops that they have from time to time, and the last 3 or 4 weeks have been out completely. I just have not seen any charts. They look terrible, and I stayed away from them. Finally, this week, in the liquidity trader, gold trader report, I picked one chart that I liked as a buy, and I said it's early, we're bottom fishing, but this one, if it's going to go, it's going to lead the way. Now it's not a junior, it's one of the big guys, and I think obviously they'll probably move first, but I still think it's early. From my read of the charts, the daily trades, the 2 or 3 week swings that end up turning into something bigger. If you get into the right time, at the right time, you can hold on to them. It's still, as of my last look at the charts, it still looked like we were early by, if not months, at least weeks. So I'm not ready to go there yet. Will there be commodity classes that do well? I suppose there will be, but I'm honestly, I don't track all the other commodities. But again, if we run the individual charts and look at them individually in a vacuum without trying to figure out what the underlying narrative is, what the underlying meaning is, I'm sure we're going to find bull trends and bear trends in all different kinds of things as time goes on. But I think that trying to relate one market to another is difficult at best and problematic and counterproductive at worst. So I try to look at each chart as it stands on its own. It tells its own story. And if the trend is established, you buy support and sell resistance. It's pretty simple along those terms. And the best traders I've ever seen, that's basically what they did. They were pretty cold-blooded about it.
Bill, I'm in that business that's my profession, the commodity business. And if I could just leave you with a thought that some of the commodities if you use crude oil as one, and maybe some grains, they've been affected a little bit, I would say, on the positive side by some geopolitical events that have happened between Russia and the Ukraine. And I'm not quite sure that that's going to be a long-term effect. I think that that will come to an end at some point. But some other commodities have been getting a little bit of help because of government policy, and that is that there's a kind of a mandate by the U.S. government for the United States to start using electric cars. And that you might have seen copper go up because of that. So there are different things that affect different commodities. Weather affects grains, can affect grains due to limited production a little bit. I will tell you that this year up in the North Corn Belt, the Northwest Corn Belt, North Dakota, South Dakota, parts of northern Minnesota, they've been inundated with some rain. So there might be a little trouble getting spring wheat in, possibly. And so if you look at a spring wheat chart, that's a Minneapolis wheat chart, that's been affected. So longer term, to say that commodities are going to go up and equities are going to go down, to try and identify something like that, I 100% agree with Lee, and that is look at what you want to trade, specifically the chart you want to trade. Thank you.
Agree with that.
Bill, I appreciate you tuning in and your kind words there as well. The only thing I was going to add to the kind of crypto subject is that I think, I mean, in my opinion, obviously, since I don't know if anybody was here for the last crypto versus gold beatdown space that we had, that was quite interesting. And I'd be interested to hear from some of the people that were in there pumping crypto and Bitcoin at that time. But I think that as an asset class, I don't think it's a terrible thing to have some of this excess expunged out of the system, right? We've always been told that cycles are good for any asset class. If something gets overheated, it needs to pull back. But when there's exchanges running 100 times leverage, and there's all of these other, schemes, however you want to put them, that are not necessarily maybe 100% sound. I don't think that that's a terrible thing that some of this gets blown out of the system. Yeah, it sucks that people lose a bunch of money and get hurt by it. But at the same time, I think that is part of the road to build that as an asset class. Anybody else's thoughts on that?
Well, what I would probably mention is, especially with Lee's sort of top-down approach, if you look at the number, if the Fed is intent on reducing dollar supply, which would take the dollar higher, at some point that's going to start cutting off the ability to bring more commodities to the market. Because if you look at the mining sector, for example, of silver, you saw, I think it was Endeavor Silver talking about how their cost of production is $21 an ounce or something like that. If you kill the commodity sector too much, there's no incentive to mine or to produce oil or whatever it may be. And so they play a dangerous game of trying to use financial market destruction to try and kill demand destruction to offset the supply issues. And that's where my whole theory of deleveraging and removing leverage from the system, it makes a lot of sense. But ultimately, it's if the commodity becomes very tight, like we're going backwardation right now, the question is, your dollar can go up in value, but there may be nothing to buy. I mean, you look at the Northeast, and I've been reading about this gasoline potential shortage. It's 1 month of supply left for the East Coast, and or the baby food shortage. I mean, yes, the dollar goes up. But it also hurts our trade deficits. I mean, you saw the trade numbers come out this past week with new all-time low on a monthly trade deficit. So it has the Fed can only push on the string too much before they need to reliquify the system. And that's, I think, the question is, do they try to get this market down and some commodities and some of the inflationary pressure down as far as they can before the next thing breaks, and then they have to come back to the market. They're just I think they're trying to find this magical balance that, they've created this problem, but they're thinking they can solve it at the same time.
Yeah, no, I appreciate all of the comments, and I think the one thing that just really has stuck in my mind after this week was the events of this week. Just I'm old enough to have not been involved with Bre-X directly, but I was following the market very closely at the time that occurred, and that seemed as though that was a very stable, staid, senior company compared to what I've witnessed in the crypto space over the last few years. And I would say to myself that, to me, there seems to be we have now, I wouldn't say we've set the stage. We're at we certainly have set the stage for a disapproval of a lot of theses regarding the potential of crypto. And I think some of that speculative money will eventually flow back to where it's historically been. And that was, really kind of what my theory was after.
Yeah. I would agree with that. It only takes $1 at the margin to move the price of an asset. So, if any of that money transfers if there's any money left over from the crypto meltdown, and any of it moves into the precious metals area that wasn't there before, that's incremental capital coming into that market. So it should help.
Well, it also starts to kill the competitiveness of crypto against the precious metals. I just hope the precious metals industry actually wakes up and gets its act together and tries to capitalize on this rather than trying to fleece the consumer by upping premiums as high as they do. But that's another story for itself.
I would just offer that probably everybody knows, but the market really sets the rates or the price of underlying commodities, copper, crude oil, diesel, that kind of thing. The market sets it. The Fed can do what they want to try and influence the cost of money between banks, called the federal funds rate. But the marketplace, we saw it in the 10-year. The 10-year went to like 3.1, 3.2%.
Yeah.
And then it got down under 3% again. So the market sets the price.
That's correct.
That's kind of back to your supply and demand.
The Fed.
Right?
The difference is that the Fed is a direct actor in the Treasury market. It is not a direct actor in the commodities market. So you have more of a let's say, I know there's going to be those who say, well, the market is manipulated by the banks, but you don't have the Fed directly acting in that market to push prices one way or the other. And the Fed does act directly in the bond market and the stock market. And they've made a policy choice, and they're going to stick with it for a little while. And we don't know how long. We just got to watch the charts and listen to what they say. And if we start to hear signs of panic, then we got to watch the charts a little more closely for signs that the market's going to change direction. That's got to be my last thought, guys. It's 20 after midnight here in France, so I'm going to cut loose here. And thank you guys very much for having me. I really appreciate it.
Thank you, Lee.
Very much. Thank you, Lee.
Thanks for joining us, Lee, and we'll have to set another one up when you have a bit more time.
Okay, thanks again.
Bob, did you want to maybe expand upon the premiums idea a little bit more, or move into the metals a little bit more?
Well, there's a lot of frustration out there, especially on the consumer side. Talking to I talk to people every day, and the biggest complaint you start to see now is that, hey, listen, the price of silver just dropped $6 or $5 an ounce, and now my premium to buy a coin is, instead of 40%, now it's 60%, or it's, if it's Eagles, or if it's another 1 ounce coin, it may be 35%, and it's doing a disservice by attracting more people to to this market, and part of this I think is part of it's coming from on the minting side, the inability to maybe make enough product, and that's forcing the worries that tape premiums are going to go up on the wholesale level. And the oddity about it is the wholesale level, they've actually raised their bids when they raise their offers, and you see maybe a more defined market amongst wholesalers. But when you get to the retail side, you see these huge spreads where you see you buy the market at X, and then if you want to sell it, it may be at spot. I've seen these closed loop programs that, not to mention names, but they're selling 100-ounce bars at $4.50 over spot, and then you want to go sell it, and they're $1.10 under spot, and that doesn't serve a purpose. I mean, it doesn't provide. That's why you almost need some type of. To me, you need more of a listed or national type of exchange that has more price transparency. But it's something that I've been trying to get some feedback on and maybe get some momentum with, especially with some of the technology guys out there that that can create the software platform on the trading side. But you can, from the physical side, you have depositories that are scattered through the country that could act as clearinghouses or clearing custodians, I guess you could say. It's very similar to how the COMEX works, with the idea of verifying metal, that type of thing. And then you basically trade the exchange is not a leveraged type of futures market. It's really just a physical only market that if you want to place an order to buy, you buy it. If you want to sell it, you're selling what you have in your account. There's no artificial sound. But that may be something where you start to build more momentum where, hey, listen, the price of a Silver Eagle now is more recognizably known in the marketplace. And so I'm willing to pay $12 over spot because the bid on it's $10 over spot. And then that starts to reshape the market amongst a lot of the smaller products. It's not the perfect system in the world, but it's something that's well needed because right now the way we currently have it, you have a player in the market who has bought a lot of gold dealers, owns a large stake in the real only refiner or fabricator that makes the blanks for the U.S. Mint, and there's a lot of conflict there, and it's something that that conflict allows them to maybe control production for one asset, whereas then they can get the premiums up on that asset, and then they can turn around and now that they control that minter, that minter can then make just generic 1 ounce rounds for them, and they could actually make more of a spread on selling the rounds than they can on the Eagles. And so you see there's a lot of problems that I'm seeing in the industry that certainly could be cleared up or addressed. But that's just one portion of it. And then you have the issue right now. I think what's taken the metals down is you haven't seen as much physical selling, but you have a lot of programs that are borrow against your gold. I mean, that's been a big thing the last 3 or 4 years as the prices have come up. A lot of dealers and programs now offer loans against your precious metals. Well, that's potentially an issue of liquidity amongst these programs and dealers, because if the price continues to drop, those margin calls can start setting in, and the question is how liquid are these programs, as well as how liquid are the people that have taken loans out against their metals. They may end up being forced to sell metals back into the market, and that's what happened. I think it was 2013 or so when Monex had a big program, and the price of metals dropped like a rock, and people got wiped out because they didn't understand the leverage and margin application against their metal holdings. So you have that, and that if that happens, that actually could add supply back into the market, and that could potentially reduce premiums. But that may have an impact on price. And so there's a lot of moving parts here that I'm trying to watch.
Bob, do you think that there's any way to build a program like that where people do borrow against their metals that would be feasible?
Well, if you're doing that, that should just be, it's you got to know your counterparty. I mean, for the problem that if a dealer wants to get into that type of business, and obviously silver is a very, very volatile asset. And I see these programs that are offering 80% loan to value. Some may be a little bit more conservative, 65% loan to value, and some may be a little bit higher to earn business. But the issue is you get these price swings, and the programs don't have that liquidity pool. Because most of them just borrow from a bank, and the bank basically takes some type of lien or ownership or potential ownership against the asset. It's held as collateral. They're not banks. It's not Wall Street. It's not. There's a bank on Wall Street, for example, sort of has a much higher line of credit and ability to borrow. I mean, if they have to, they go to the Fed. In a private fashion, you really don't have that ability. And just like we've seen with cryptos, and these leverage schemes, the selling can begin more selling, and all of a sudden you have forced selling, and then you have something you can't stop. And that's obviously, it'd be hard to see that, a small program blowing up a major market. I don't see that happening, but it's just that small program blowing up itself. And maybe other players, other customers that aren't borrowing against their holdings, potentially could get impacted if they're just happen to be in that program as a long-term investor, thinking, okay, this is a safe place to be. I bought metals for the reason of inflation or uncertainty or geopolitical events, that type of thing. But then they get sucked down with this program. That's what I try to help people. And that's one of the reasons why I kind of spout on Twitter. Read your agreements. I don't care what the program is. To me, it doesn't matter if it's. I'll speak out against it if their customer agreement says, they basically has carte blanche in terms of we're going to lay all the risk on to the client, and we're going to basically have a clause that says, hey, this is our limit of liability clause, and you don't have any type of recourse against us. That's the kind of stuff that I hate to see, because many people in this market, when the price is going up, nobody questions the program. It's when the market goes down and these programs start to get less liquidity, and the transactional business that they built their model on starts to die down. That could actually impact as well. We've seen that 2018 and 19, there were a lot of wholesalers and people in the industry that were losing money. And you saw some people try to raise fees on the storage programs, to try and offset their lack of transaction business. What if we get into a market environment now that we just got smashed here? What if we go sideways? We build a base, we go sideways, and maybe before biding time before maybe the fall when the Fed's maybe forced to reverse its policy. If the financial markets run into more issues, at that point. How are these programs going to survive in that type of atmosphere? But more importantly, if a person does want out of a program, what's the bid going to be when they want to sell their metals? And those are things that I kind of look at.
Mm-hmm. Absolutely. Omar, you've been waiting patiently to ask a question about silver.
Yes, I am relatively new to the precious metal market. I do own silver in my house, and I do own a few bars, 1,000-ounce bars that I keep with Bob in safekeeping in the vaults. But I have a question maybe for Bob and maybe Jim. It's a simple question, but I suspect the answer may not be so simple. I follow markets, I follow stock market, I follow bond market, and the silver market is so opaque. I'm looking at the spot price and I'm looking at the futures price, and you don't know what's moving what. What leads what here. I mean, how do you explain when you have different prices or you have backwardation or you have contango? I mean, is there? Well, I guess the main question really is what leads what, and so what determines the spot price and what determines the futures price, and which one influences the other? Yeah,
that's a good question. It depends on liquidity of the markets at the time. That depends on whether we're tight or whether we're loose in the marketplace. So there's a number of different things. But if you look at backwardation, and that's basically where the spot price is now higher than, say, the lead month futures contract, and there's various degrees of backwardation. You could look at backwardation on basically the entire forward curve, or maybe, hey, listen, the 3 month or 2 months or whatever the lead month contract is maybe it backwardation compared to a year out contract. I mean, there's different ways to look at it, but with what leads what, some of that depends on market forces like the exchange for physical transaction, or the premium you try to watch for, where London and New York are, they have basically it's a spread trade that says, okay, I have physical and I have a futures position. The futures may be the hedge against my physical, and everything's fine in a normal environment. There's a typical spread that that stays fairly consistent. You throw an event in there, and all of a sudden, like with Russia, what was interesting when they invaded Ukraine, all of a sudden there was a lot of money. Well, a lot of money came into physical, but you also had a lot of money flow into that Deutsche Bank. A lot of money came into ETFs, and there's some ETFs as well as also into the futures market that buy futures contracts. And then all of a sudden you had a big demand for buying futures contracts, and that lifted the contango even more, and you started to see a bigger spread developing between spot and say the lead month futures contract, and so like a month ago that spread was very, very wide, and we kind of found out that some of that was due to this massive amount of money that came into some of these ETFs that, for example, Deutsche Bank was managing, that they what was it, 2 or 3 weeks ago or 4 weeks ago, they started to stop. Basically, they had issued a lot of securities into the marketplace without having them legally registered, and so they had to unwind that and cut that trade off, and that, I think, started this selling that may have started in the marketplace on the futures market. Well, the futures price goes down, you selling begets more selling, stop losses get hit. And then all of a sudden the price goes from 26 down to where it hit 21. And now the question is, now you're getting closer to the cost of production of silver for a number of different producers. And so there's less silver that potentially could start coming to market. At the same time, industry is still needing that silver to, for their products and so forth. And so there becomes a point where the physical market starts to tighten up because you have the worry that future supply may not be coming to market. I mean, things don't happen that fast on a dime, but these events are sort of, it exaggerates the moves just to make a point. So.
And what about volume? Like, are you able to see, for example, you see the activity in a week in the physical market? Are you able to see, what actual volume transacted in that market versus volume that transacted in the futures market, and maybe compare, what's real and what's not real?
Yeah, there's a lot of one of the spaces we did, individual who talked about, and I've talked to players out there. You're seeing less visibility of where metal's going, and where it's not necessarily exchange driven transactions. It's maybe OTC or over the counter type transactions, or it may not be reported in import export numbers, where you're seeing metal be taken off exchanges and then simply held off for example, the COMEX, are held outside traditional vaulting environments that don't necessarily report, on published reports like you have, like on the COMEX, for example. You have the stock reports that they have, and they'll show the registered category as well as the eligible category. And the eligible category is just simply bars that meet the definition to be able to be put on the exchange, but it's just held in private name. And so you can kind of track that. And LBMA, obviously, which I think think they're very opaque. It's almost impossible to define exactly how much metal's actually over there, because you got a lot of ETF activity, you have a lot of leasing activity. Yet there's a lot of the authorized participants may have hedging strategies or active trading strategies or proprietary trading strategies that may utilize the ETFs as well. And they use the ETFs as an inventory pool for their own activity. So there's a lot of things that go on that makes it even more difficult. But what I try to do is watch talking to players out there on the physical market is, hey, listen, are you seeing selling coming into the market? Are you seeing bids, dealers looking for bids? Maybe they're seeing selling that's coming into their program, or are you seeing other players out there? Are the number of transactions you're seeing, are they smaller transactions or a lot more transactions but smaller per size, or are they smaller amount of transactions but they're larger in trade size? Meaning typically when you see those bigger transactions come in and just fewer of them, that's usually bigger players coming into the market. And I kind of look at that as maybe a little bit smarter money looking for lows, whereas the retail crowd
less emotional maybe, right?
Yeah, the retail crowd is more momentum driven. I mean, certainly when you get this jam down in the marketplace like we had in March of 2020, retail came in, institution came in, everybody came in. And then all of a sudden you had the shortage of metal and premiums started going through the roof, and it got really difficult really fast. But in these sort of these trending markets, I guess, or these big wide trading range markets, it's easy to see retail sort of get disenchanted and they walk away, but you see larger players continuing to buy. And I started to see that activity back in 2019, late 2018, 2019, where retail started to walk away from the trade, and they were just, the crypto market was, percolating, the stock market was going up, real estate was going up, and the metals looked like they were just, you couldn't give a gold eagle away. I mean, in fact, the wholesalers were bidding under spot for gold eagles, which I'd never seen. But what you did see was people, high net worth investors, buying the metal and reallocating their portfolio and saying, listen, I'm not buying this for the next 6 weeks. I'm buying this for the next 6 years. And that's the difference, I think, in the physical world that we see versus maybe Jim's world, who does more on the futures market, which is more on the trading, maybe short-term oriented, maybe medium-term oriented type stuff. That's, I think, that it's easy to crack the gold and silver bugs and say, God, you guys are always going to be wrong for the rest of your life. But the way we see the market, it's, the way I see it, it's like playing chess. I mean, all this activity on the markets is just noise. It's just pawns moving around. I'm more worried about, what policy is going to be 6 years from now when, this money printing game, the market finally takes away the ability for the Fed to create dollars at will. What's tax policy going to look like? What's social policy going to look like? What type of political directives are we going to see? And that, and you multiply that across the globe.
So I think what I'm hearing is that the physical market is so fragmented that by default the futures market takes the lead in determining a price. And I guess that's where the opportunity would probably come up.
Well, it's the futures market on a dollar volume basis trades so much greater than the physical market. But March of 2020,
so much greater than it's beyond the amount of physical that can be actually gotten.
Correct. There is a leverage factor. Yes, you're absolutely right. Now, what's interesting, in March of 2020, something interesting happened where open interest and trading volume it fell like a rock, and it never came back. In the for example, the COMEX, and so you started to see, and more metal came onto the COMEX, and you started to see this leverage effect start to die. It's almost like, and then you had Basel III come into effect last year, and that gave more impetus for the banks not to be leveraging up in the precious metals realm. You're seeing this idea that it's almost like the only way out of this mess is inflation, and which I think that's the only way out. Otherwise, if Lee's right and the Fed just pulls away pulls the plug on keeps QT on much longer, everything just gets crushed. But the question then is, gold and silver, you got, it's one of the assets that never really participated in the last 10 years. It's the other stuff that you have to worry about more. And then you have the question of, and that's why I keep thinking, the only, at that point, the question is, what's the dollar really worth if asset prices completely collapse? There's no way you're going to pay the bond market off, and then you have a true recession coming into the market. Because a lot of people do see a recession on going out over the next year or two. The question is it going to be stagflation or is it going to be a deflationary recession? That's, I think, what everyone is trying to understand, and maybe the market here is trying to say, listen, we're scared, that it may be a deflationary recession coming, not necessarily a stagflationary environment, and that's probably one of the reasons why the commodity, why gold and silver sold off. It could all, to me, I think it's more leverage. I think it's more people got caught and sell, and people that were getting stopped out. The mining, the problem is as the dollar increases and rises, it kind of, and oil prices haven't come down at all. The mining industry is just getting double whammied here because the cost of production, their input costs are still very, very high, and you got the dollar going up, and then you got the metals pulling back, and so you got this massive leverage effect to the downside on the miners. But we've seen this before. We saw this in 2008 where the miners get crushed. You've seen it in 2013 when the market finally broke apart on gold and silver, and it got flushed to the downside. But I put a chart up on my feed about one thing is a little bit different here than 2013. In 2013, you had consumer sentiment bottoming and actually rising and showing that, hey, listen, real yields could actually be supported by rising consumer sentiment. In this environment, you still have negative yields, but you have consumer sentiment that's been going down for the last year. I mean, it's been it's not supportive of a tight monetary policy. And that's why, to me, this isn't going to be like 2013 where gold and silver get cracked and stay down for the next six years. I don't see that happening. And then you couple that with the ability for people to buy more physical metal, and you're seeing it. I mean, you see the numbers. I mean, CPM does a great job of putting out numbers, and the Silver Institute, all these other places show supply and demand and that type of thing. I think you're seeing more people wake up, and the interesting thing with crypto is that maybe we don't get a lot of money from crypto from the bloodletting that's happened, but maybe it wakes people up to say, hey, listen, I bought crypto maybe because of the idea of money printing and trying to protect my my purchasing power, but now that's not it. So the metals may make a comeback the rest of this decade as the go-to asset if you're looking for maybe a safe haven and that's, to me, that's what I look for beyond this little pullback right here. It's the narrative that is going to that'll attract people to the asset class. I'm just hoping the industry doesn't get as greedy as it has in the past and just keep these premiums jammed to the ceiling, and then all of a sudden it just dissuades people from buying metal. That's my worry.
What I don't like,
thank you, Bob.
What I don't like, Bob, is the bid ask by the retailers. They want, like you say, $14, $15 for a Silver Eagle over. And if you want to sell back to them, it's spot or $1 over or $2 over. So you have $10 or $12, bid ask spread. That's what I don't like.
Yeah, and the frustrating part, and I totally get it with the physical crowd is that, the argument is, hey, listen, the futures market kind of dictates the spot price because it's so much more heavily traded. There's so much more volume in there. There's the miners. People don't understand that the mining community creates a lot of this short interest by using the futures contracts as a hedging tool against their underlying production, and that's sometimes the cure for that is if prices go low enough, they're not going to be mining as much, so they're not going to be shorting as much. So then that kind of starts to offset that commercial activity. But that's more of the intricate market structure, on sort of a day-to-day basis. I'm more concerned on looking at, hey, listen, how much can the Fed really press the markets and reduce the balance sheet before breaking something? Because like Lee was saying, it doesn't take a lot to start seizing up the real estate market. I mean, that market is literally at the margin of everything. I mean, and it's one of those things that there's a lot of supply that could come onto the market if interest rates go high enough. And at the same time, you have that the monthly payment effect where people can't afford the price of that house because now the monthly payment has gone through the roof because the interest rate has gone through the roof. And so
and the wealth effect too from people's, let's say the value of their house drops down and then they don't feel like they have the ability to spend against it, right?
Yeah, and that's where a lot of bigger players that come, high net worth individuals, that's the game that they look at. They look at this from a much longer term perspective. It's frustrating to see the metals get jammed down in price, but the futures trader, the guy that's speculating, they get wiped out. But to us physical guys, this is like we're just sitting there eating popcorn and watching, the horror show right now. But eventually it just like it's cyclicality. It'll turn around and you'll get the metals either come in favor, or you'll have the Fed start to turn around and try to they may use RRP to try and push down yields artificially. I mean, there's different tricks in the book. And that's what I tried to focus on, is not as much on the conspiracy side of, hey, listen, the market's being artificially suppressed. I mean, the market's going to do what it does. It's trying to understand what the next steps are going to be to make sure, hey, is my narrative right? Am I looking at this completely wrong? Because to me, at some point, the gold and silver trade is not a U.S. only trade. Like in 1980, this thing is a global trade where, you're going to see if the euro goes to parity with the dollar. I mean, imagine being a European and just getting crushed, not only on if commodities don't go down in price, but now your currency's dropping like a rock at the same time. I mean, there's a lot more people outside the U.S. than in the U.S. That are going to be affected, and that's why I think you're going to get this. The dollar can only go so strong; it chokes off the world, and then all of a sudden the world says, "You know what? Here's your dollars back. We're going to just throw it into our own economy just so we can try and have some resemblance of and rebuild our own economies." And you'll get that cyclical move again, and the dollar will drop like a rock, but that takes time. You have to get to these extremes first.
Hey, Bob, I want to express the sentiment of the previous person that threw out a question to you. I've been dealing with gold and silver since gold was about $760, $770 an ounce. And I had to go through, these retail sellers like Peter Schiff and APMEX and other people. And there's a big layer of fees and all these administrative costs that the retail buyer and seller has to go through, and it's you said it's the intricacies of the market. It's not the intricacies of the market. I think it's greed.
Yes.
I mean,
yes.
With some of these people, I've lost Peter Schiff. I lost $50,000 dealing with his securities and his opinions on what stock is good and what stock is not. I'm not blaming him. It's ultimately my decision, but. I mean, when I have to pay $15 an ounce over spot for silver, and then when I do want to sell, and they just give me $1 over spot, that's not intricacies of the market. That's called greed.
You're absolutely right. I mean, when I was talking about intricacies of the market, it's more about the EFP. How bigger players, funds and banks and trading desks and commodity trading houses and so forth, how they're actually interacting, authorized participants. But you're right on the retail level, and this is something I've been outspoken against. I've been the silver squeeze movement. I've been pretty much banned from them because what I was saying in the silver squeeze movement was, wait a second, this is more of a squeeze on premiums than it is on actual metal, because it gave a chance for the dealers that had been losing money for 2 or 3 years. They can now start basically pricing the product at will. And that's what happened in 2020. It's like dollar signs just went up in their eyes. And then you have not only that, the part that makes me sick is not just how people have gotten taken on very, very high premiums, because I know I've talked to so many people that have paid $2 to $4 more per ounce than I was selling the same product for. I mean, in 2021, I was selling, or even 2020, I was selling 100-ounce bars at I think it was $1.25 over spot at the time, and I think everybody else is like $4.50, and I'm like, why are they selling it for so much? And because we're all buying it from the same wholesaler. That's the part that I hate. And then on top of that, you go to these online dealers and you look at their spot prices that they're advertised, and they're 20 or 30 cents higher than the actual spot price themselves. And what does that serve? I mean, that's greed on top of greed. I mean, not only do you have to make it more on the markup of the product, now you have to create a some type of advertised spot price. And it's a very frustrating thing, and I'm telling you, people have been waking up to that. I've been talking to people, and they're like, you know what, I felt something was wrong last year, and now I've heard, because I've been on interviews with Tom, and I've talked about on that, and I want people to just become more educated about the market. It forces the players in this environment to start becoming more respective of their own consumer base rather than fleecing them. To say that, hey, listen, the product, the train's leaving the station, we're not going to be able to find any more product. You got to buy it now. It's like now or never. We don't know if there's going to be ever silver again. I mean, or when the next time you're going to be able to buy. Those are inflammatory comments that, and then you throw on a massively high premium. It doesn't serve any purpose, and I feel it. I mean, that's why in 2008, I saw the need for physical metals. I opened up a depository. I'm the only depository in the country that's not owned by a gold dealer or a financial institution or a cash in transit company. My model is completely opposite of everybody. That we're a storage company first, and I'm also a registered investment advisor, and as a subsidiary to that, I have ability to basically be a purchaser representative to buy metals. I don't mark the product up a lot because I don't need to. The storage facility, we have a $500 million all risk policy. We are a very big player in the market, but I don't need to mark this stuff up a lot. I have a lot of respect for the client base. I respect them much more than the premium, and it's a shame because and the way my business model is set up is I just buy from the wholesalers, and they ship it to me, or I can drop ship it to the client. I don't have to play the hedging game. I have some very, very good relationships in the business, and I tried to make this as the most efficient model possible, so because I can pass the savings on to the client. And that's what, I don't know what the perfect model is going to be. And there's a lot of good dealers out there. There are a lot of smart guys out in the business, smart gals in the business. But I've heard so many people frustrated by how much they've actually had to spend, and now they're realizing, wait a second, I just bought a bar for $8 over spot on silver when it was at $26 an ounce. Now the price is $21.50. I look at what they're bidding on these things, and now it's like, talk about feeling distraught. I mean, and then what I tell clients is, well, wait till the price goes to 35 or 45, then you're going to get people selling into the market. The premiums are going to fall like a rock because you're finally going to have secondary product for sale. Yeah, and that secondary product for sale may not hurt the price, but it'll just hurt the premium. I mean, the spot price may be more influenced by the 1,000-ounce silver bar market than it will be by whatever the price of silver eagles are at the time. But that's the part that I want to see played out much better in the marketplace.
Chris Rutherglen, another previous guest of the show, do you have anything to add or any questions?
Oh, I was just gonna. Hi, Tom, and hi, Bob.
Hey, Chris.
I was just gonna mention it's probably more related to what Lee was saying at the beginning, but QT. If you look back at the previous QT when they were tightening, the money supply really didn't contract too much, and although the reserves were going down, the reason is because the banks, which also create money through loans and credit creation, actually sort of picked up the slack, if you will, and still kept it going. So money supply was still increasing at that point. So as that relates to the current environment, I was kind of thinking that it's probably best to watch it. There's no prediction on if that's going to repeat, but because we have a recession, sort of beginning stages of a recession going on now. So it could be the banks pull back on their loaning and credit creation, but it's just something to keep in mind, that you could still have the liquidity there, even with the QT.
Yeah, it's an interesting point because we talked about MBS or mortgage-backed securities, and as interest rates start to rise, you don't have the refinancing that goes on that you typically have when interest rates are falling. And now that we've started QT from an interest rate, I guess we'll start QT in June, but you're starting from an interest rate level that's much lower. You're not going to see the refinancing activity, so therefore you're not going to see maybe the loan activity that potentially expands that money supply, and that creates tight liquidity conditions. And if it's designated into the mortgage-backed security market, it also creates tighter liquidity conditions in the real estate market as well.
I think so. During say like 2015 to 2018, 19, so rates back then were around. On the 10-year, around say 2 to 3%. So it's not too far off from where it's at right now. So I'm just throwing it out there. I really don't know which way it's going to turn, but it's just something to keep in mind. And the other comment I was going to make related to the confusion regarding whether quantitative easing creates money. And so the confusion arises from, it's sort of a two-step process. In the money creation. So the first step is the banks need to buy the treasuries. And in that step, they buy the treasuries and create a deposit on the liability side. So that's where the money's created, that step, the first step. The second step is they sell the treasuries to the Federal Reserve, and that swaps the treasuries in their assets for cash reserves with the account there for basically the reserve. So when people talk about it not being creating money, they only look at that last step 2, and they don't look at step 1. And I think that's the important distinction that people need to make.
Yeah, and you see it with asset prices. I mean, if it's not money printing, how the hell do asset prices go through the roof? I mean, that's, if you look at the Fed's balance sheet, there's a direct correlation between that and the S&P 500. And also the primary dealer system. Primary dealer system relies on that whole program.
And not only that, but you can also just look at so if you look at, there's 2 ways to create money. Either the commercial banks or the Federal Reserve with the QE. You can look during the periods, and if it's not created by the commercial banks, see what the reserves are created, and you find out, like during that period, QE 1, 2, 3, and then the QT, that if it's not the commercial banks creating it, it sort of matches pretty roughly with the reserves created. So all the proof is there. It's just when I see people talk about it, they kind of they miss it. They just look at that last step, and they don't realize that it's not just creating reserves. There's a deposit first, because unless the banks have a lot of treasuries on their balance sheet, they got to get it from somewhere.
Well, the primary dealer system is the one that actually buys the treasuries from the treasury itself directly, and then they turn around, and what they've been doing the last few years is they've been selling it to the Federal Reserve, and the Federal Reserve has been cashing out those primary dealers, and some of the primary dealers, their parent company are the banks. And of course, then you had after 2020, you had the SLR, and you had the reduction of the treasuries that the banks were allowed to buy didn't have to go against their leverage ratios. So I mean, but that got removed last year. But it's going forward. I think Lee's right. You have to look at right now. We're in a potential tightening cycle, which is very indicative of a bear market. The question I think that all of us as precious metal owners, as potentially stock owners, as well as everybody for that matter, is how far can the Fed go before something breaks? And the question is, do they want to try to? Are they trying to try and control this slide to try and damage the wealth effect, which damages demand or creates demand destruction, which offsets the supply constraint issues, and try to allow supply to actually come back and rebuild into the marketplace? Or do they actually try to remove speculation out of the system altogether and try to tighten, at much further level than any of us are expecting? And that's something I mentioned in the last Spaces cast with all the Bitcoin people. I said, well, you got to be careful, because the Fed may be doing something that none of us are really expecting, is they may go tighten a lot more than people think.
There's a recent interview with on Macro Voices with I'm blanking on his first name.
David Rosenberg.
David Rosenberg. That's right. Thank you, Tom.
I've had him. Yeah, I've had him on once, I think.
Yep. So he it's probably worth listening to, because he sort of has a sort of picture that's sort of similar to what I have, in that they're probably going to have to back off from all this tightening that they're going to do, and then eventually start to cut rates and cut the QT. And one can listen to the interview, because I probably don't have time to repeat everything here, but eventually I would agree. Eventually it does come back, and sort of things sort of blow up. And for people who sort of follow me, so my forecast is that you get that big move up first to 3,000 or so, and then that sort of crash event back down to 2,000. So the QT and the tightening eventually does break something. But I think in the interim, you get that first sort of larger move up.
Yeah, I think if you're really looking at longer term, I think that at some point, this whole madness is going to end. Whether it's going to be war that does it, whether it's going to be the market that pulls the plug from the Fed's ability to play these games, or is it going to be basically the public's anger about basically everyone getting bailed out while they're sitting there losing their shirt, whether it's in crypto or stocks or whatever it may be. But you're going to get something that forces that ultimate change. When that ultimately happens, I mean, I think you're going to get, in the metals, you're going to get an ultimate melt up, but then, and that may correspond with potentially a, increase in frustration out there, increase in political uncertainty and a more difficult political environment. But it may also couple with, the rest of the world kind of feeling the pain too. And that's, because you got so many dynamics going on right now. You got this Russia thing. You got which doesn't look like it's going to end anytime soon. You got, and I've said it before, where I think Russia almost kind of just threw a grenade right in the middle of the financial system, and they did it literally at perfect timing. I'm sure these guys, just didn't get it by luck. I'm sure they looked at the idea that the Fed has to at some point try to, address inflation. Well, now we got a situation where if we don't get the supply constraint under wraps, we're looking at some serious problems maybe next year with whether it's baby food or diesel gas or just food in general. I mean, it's pretty incredible. I mean, we're living in. I thought we saw everything that we could see maybe in 2020, but I mean, who knows where we're headed. And it's just a symptom of too much money and all this malfeasance wrapped up in the system, and eventually you're going to have a reality check. And the question is, where do you put your assets? And to me, being in the business 30 years, the way I see it is, I'm more concerned about a return of your money than a return on your money. At some point, and that's where the counterparty risk and systemic risk and some of these other types of issues really start coming more into play.
I like your wording there, Bob. A return of your money, never mind a return on your money.
Yeah, it's just to me it's. Yes, you can short the market, you can play it from that side, but hey, if the market starts to become unglued, what's to say like we had like Robinhood, just with GameStop, that situation where literally almost not only took down Robinhood, but it took down their clearing member or clearing firm, and then potentially could have started a domino effect amongst other clearing firms, just because the stock was going through the roof. Imagine what happens if you have the exact opposite and the market starts cratering, and then all this collateral that's out there is losing money, and then you have this treasury market, which is the treasury market now, the collateralization of treasuries is become more important than the treasury itself. And so if interest rates rise, that's why interest rates can only go up so much, because of all this collateral that the treasury is being used for to borrow against other assets. It's become insane, and that's why, to me, physical metal makes more sense, because imagine in a world where people start buying physical and they stop buying all this garbage ETFs that, buy like, the DB silver fund that goes out and borrows money or buys, some of these funds that buy treasuries and then borrow and basically go long futures contracts, silver futures contracts, or some of this crazy stuff that you see. But they call it like you're buying the actual metal. I mean, that's where change could actually take place, and that's one of the reasons why I'm a big proponent of physical metal, because that's the only way the system could actually shape up, is you somehow deleverage and break all these the sort of games that are played. The I don't say games would be the word, but the effects of all these trading strategies that tend to smack the price hard because someone just simply has the wrong trade on, maybe too over leveraged, and all of a sudden gets basically stopped out and washed out. But yet we all sitting here watching silver price go down thinking, my God, this is the end of the world. But in reality, it could just be some guy who was over leveraged and just got crushed. So,
Bob, do you care to maybe just briefly mention commitment of traders, what the result was today? Thank you.
Oh, yeah. If you look at one of the things I look at on the commitment of traders report, it's more of a contrarian type of report. It gives you what the long crowd or the speculator or non-commercials are doing, as well as the commercial accounts. And so the commercials, everyone tends to think are the banks, but they incorporate producers and other larger players in the market that may use the futures contracts for hedging strategies, that type of thing. And you look at the non-commercials, which typically are the managed money crowd. It's sort of the I don't want to say the retail, but it's more the fund and sort of the momentum crowd, I guess you could say. Because typically what happens in the precious metals is you see more volume start to build when prices go up, and then and at the same time you have commercials that start to increase their positions when prices go up, because it may be mining outfits or it may be players that are hedging against physical positions that they're more concerned or maybe become more price neutral at certain price levels. So they'll lock in. They may use a short to lock in a gain against a long, or basically to become price neutral. So you watch this report, and what you've been seeing here with this price going down is that the non-commercials, the managed money crowd, has just been getting obliterated, and now they're going more short and less long. Well, this last report, they actually went short 3,065 contracts, and they went short 12,000 contracts on silver, whereas the commercials actually closed out 6,300 contracts and went long 2,453 contracts. So you're seeing the bigger players actually think, okay, we're probably closer to a low, whereas the retail crowd or the momentum crowd is thinking, okay, the price is going to keep going lower. We're just going to keep shorting. And you typically see that, especially when it gets to extremes, you start going the opposite direction. What I found interesting, though, that on the commitment trades report I posted on my Twitter was I looked at the micro gold commodity exchange. The COMEX has a micro gold contract. And interesting enough, it's I never really looked at it before, but you actually are seeing almost on a 3-to-1 basis on the non-commercial side more shorts than longs. And in fact, actually this week you saw an increase in the number of shorts by 1,400 contracts, whereas only 114 contracts went long. So if you look at the micro gold, which may be more of the retail investor, they're actually short gold at this point, net short, just looking at that commitment traders report. The commercials don't really get involved with that, with the micro contract. So it's kind of difficult to kind of see, have any inference what commercials are doing based on that contract. But I thought that was kind of interesting, how you see, an offset of maybe how the retail feels about, from a sentiment standpoint.
Bob, maybe you and Jim could speak to this. I know we spoke about it last week, and I would like to hear your guys' thoughts about how backwardation in the metals has, like on the futures contracts, has evolved over, let's say, the last week here.
Yeah, well, when the price gets smacked like it does, the question is it selling? Where's the selling coming from first? If it's futures related, or if it's physical related, or if it's both, and then how does that relate to the EFP? How does it relate to the forward curve structure? All that kind of stuff. So you try to dissect it a little bit to try and understand the selling posture. And so when the price goes down like it was now, that was really, it looked more like forced selling, deleveraging and so forth. And, maybe funds that were starting to put on short positions, maybe what they call pressing the market lower. And you kind of saw this with the commitment trades report, where you had, managed futures or managed fund accounts adding to their short positions, trying to play the downside. Well, when that happens, the question then is, well, what's the physical market look like? Is it everybody selling along with the paper markets? Are they both in sync? And if they aren't in sync, what tends to happen is you start to see demand for actual physical metal start to pick up and say, hey, listen, I'll take that 1,000-ounce silver bar because the price is so cheap, and maybe I'm a fabricator and I need it, and this is the time to start loading up on inventory. So they start buying the physical product, and all of a sudden you have that sort of at the margin change where all of a sudden the physical becomes more in demand, while the paper forward contract or futures contracts, being pressed lower and lower and lower. And that's where that backwardation, it's one reason how backwardation can kind of develop. I can let Jim kind of talk about that too.
Yeah, I guess that backwardation, you can view it as friendly, in my opinion, when they want the product, promptly. And futures, unless you're in delivery, which we're always in delivery at some point, and on the front contract, we're always in delivery. But the backwardation, I would view it is if the spot price is higher than the futures, that the cash people want it now. And I guess when I'm looking at the silver here, at the end of the day today, the July front month, well, there's a May and then there's a June silver, but the front major market in futures went out today at 5 o'clock at 21.12.5, and the XAG, the spot XAG based in US dollars, was 2111.8. So a little under the spot, or a little under the July futures. But in gold, just like Bob is saying, the gold futures for June, the next major month for June, for gold is June, it closed at 1810.30 at 5 o'clock, and the XAU in US dollars was 1811.98. So looks like about $1.70, almost $1.70 premium or backwardation, where the spot is higher than the futures. I would offer that futures traders don't typically care about spot. Spot isn't derived from futures trading. Spot is derived from for-profit entities that might be somebody like Kitco or SilverSeek has got a spot, and then this XAU for gold and XAG priced in dollars for silver. It's somebody deriving a spot trade. And when I looked them up to compare them, they're all three different prices at the end of the day. So futures traders, they might care if we're in backwardation for futures contracts. For example, now in grains, it's different because grains, there's a new crop month that can be lower than the front month, than the old crop months. But just in speaking about futures for metals, if the December silver was significantly below the May or the July silver ahead of the December, not next year's May or July 2023, but the current month is in delivery, the May. So look at the July silver. If the July silver was $22.50 and the December contract was $21, that is where futures traders can derive a spread trade to make a guaranteed profit, but they would view that backwardation in futures contracts specifically as friendly when the front month, not spot, but front month futures is worth more than the back month. Typically in metals, you get paid for the insurance and the inkling that in the future the price is going to be higher. So the December, you would expect it to be over the July in silver, and the December gold you would expect to be over the June gold.
Yeah, I think it's important to kind of look at maybe another commodity too, because if you look at to make a point on potential supply constraints, and you just look at oil. I mean, you look at the forward curve on oil, and this thing is like permanent backwardation. I mean, it just, you get the price, you get almost like the front month contract, and it just goes down straight from there all the way. I mean, just looking at the 2026 contract on August, it's at $68 a barrel versus right now it's at $106 or $110 a barrel. I mean, there's some really weird stuff that's going on. Maybe they think that there's a bunch of oil that's going to be coming onto the market, or maybe they think that there's going to be a recession that ultimately kills demand destruction, or maybe it's just the current issue with the ability to maybe bring oil online right now and the demand for it at the margin right now. But these are all things that you just look at, you just try to make sense of, as an investor, and say, okay. You look at the actions of the Fed, and you look at the real estate market, and yes, interest rates could come back down, but you've already had a massive run in real estate. Who's left to buy? And then the question is, you've had BlackRock and Zillow and a lot of these companies go out and buy all these properties. They're going to start to try and lease these things out, or worse, what happens if they get redemptions in their funds and they now need to start selling assets off? That's the part that I try to look at is, what's the risk to this whole thing? How much can the Fed really bloodlight out of the market before you start seeing the unintended consequences, the second and third tier effects. And that's the part that that's why, from my standpoint as a physical metal owner, I don't know if a bank's going to be around if you get into a banking crisis. I don't know if there's going to be a clearing firm that's able to stand up in front of if a large party like the nickel trade or whatever may happen, somebody just happens to bet the wrong way, and you have this you have the worst of all worlds, where asset prices are going down around in almost every asset class. What are you going to sell to cover that margin? I mean, it can get scary. I don't know if anybody else has questions at all, or
Bob, I was just going to ask you, like, how far do you think any of these markets need to fall before, counterparty risk like that starts to come into question?
Well, it seems to me, if you look at like 2008, I mean, the market goes down, and I don't know where they come up with these numbers and so forth, but 20% down's a bear market, whatever it may be. But if you get down 50% down on the market, like we did 2008, and all of a sudden everyone starts, all these clearing members and banks who are counterparties to each other just start breaking, maybe that 50% number is enough to spur, maybe it's 40% down. Who knows? I mean, the problem is and it may not start in the U.S. It may start, elsewhere first. I mean, look at the balance sheet of Europe and the euro that's getting trashed right there. Imagine you're a bondholder with a negative yielding debt, that you bought 2 years ago, and now you've gotten your butt handed to you because now your currency is fallen like a rock, on top of you're not making any money on the debt. I mean, this has been the most insane environment that I've ever seen. I mean, it's we've never seen this before. I mean, even some of the guys that have been in the business 50 years that I've talked to, they're like, this is, we may not even have an election in 2024. If the market becomes unglued. I mean, you're going to get such, people are going to get pissed, because they believed in this the second time around. 2008 they got burned, and then they finally woke up and said, "Okay, I'll dip my toe in the water." In 2021, where you had $1 trillion come into the market of inflows, imagine what happens now when those people get burned a second time. And they're also 10 or 12 years older at this point. They don't have the time frame to wait around. I mean, so that's the part where civil, social chaos. I mean, you start to see these second and third tier effects that you may not be planning on. I mean, yeah, we can't all live in the metaverse where everything's pretty and there's rainbow and unicorns. We have to live in the real world, and just go down Seattle or downtown San Francisco and tell me how wonderful that that city has transformed over the last 15 years. But
Bob, we need power for the metaverse to run. And what happens when, the grid goes down like it did in Texas last year?
Yep.
Scotty, did you have a question?
Yeah, real quick, Bob, I just want to confirm something, if you can even confirm it, but global production silver-wise is roughly like 800 million. Is that kind of a general thesis? Is that correct?
CPM has, I didn't get a chance to get we sponsored one of the sponsors on their silver yearbook. I'd have to take a look at the production numbers. I thought it was higher than that. It depends on who you look at too. Some have like Silver Institute versus some of these other ones. CPM tends to have better numbers, but there is a supply deficit that is going on. I know that.
Right. And you were mentioning earlier that there is obviously metal that's out there that isn't on the market, quote unquote, tradable, right? So it could come to market at any time if a price rise was to hit. My question, and if I'm doing the math wrong, please let me know. But if just 100 million people out of God knows how many people are on the planet now, bought 2 ounces a month and took them home and put them away, right? Conceivably every month, right? They put a little bit aside and they go and they buy their 2 ounces, and that's that. Doing the math, that's a hell of a lot of silver, right, in 1 year's time. And if we're even, let's say we're at 1 billion ounces a month production, with industry's demand consistently, would not the consumer, just 100 million people buying 2 ounces a month, would that not put an incredible strain on the whole, the whole premium thing, the whole deal? Like you could build a network where you had 1,000-ounce bars and you only went to these folks in lieu of not going to the other folks that are trying to jab you, and that, that type of thing. Bring it back to the blue collar. Look, we're working hard. We're trying to keep our P's and Q's together and mind the store, so to speak, and we're getting ripped off and we're tired of it. So we're going to build our own damn network.
Right.
Thoughts on that?
Yes, I love that because it's like 1,000-ounce bars. I'm selling those delivered for $1.10 over spot. And that's these bars are, they're COMEX approved bars. I mean, we're in some instances we're just taking them right off the COMEX. I mean, it allows people to get into the market at a much more efficient manner. You're right. If the old adage, it doesn't take a lot, but imagine the one person that buys 2 ounces each, and 100 million or 200 million ounces a month or whatever it may be. Imagine how much premium they're going to be paying. Because the problem we run into right now is just production. We bottlenecked ourselves with the COVID policies. We bottlenecked ourselves with past indiscretions of other refiners, fabricators and minters and so forth that went out of business. And so you don't have as many players in the market. And so it's, you do get those bottlenecks, and that's partly where some of the premium is really built into. I mean, some of these mints, like the Royal Canadian Mint and the U.S. Mint and every other mint, they've had to raise their prices because the 1,000-ounce bar has gone up in premium, or because logistics and transportation costs have gone up, or the ability to source the product has gone up. So there's legitimate reasons for the prices to go up. And in fairness, wholesalers have to anticipate that, because when they're selling short 4, 6, 8 weeks out, waiting for that product to come in, they cannot hedge against a potential price increase. And what we saw about a month and a half ago or a month ago, there was talk that the U.S. Mint was going to potentially have to start buying kilo bars instead of 400-ounce gold bars, which would have potentially increased the premium another extra 0.5% to 1% on the price of their product. And so the distributors were all forced to start selling at a higher price, because you got to remember, they're not, when they deplete their inventories, they have to go back to the mint as a distributor and then buy the product 4 weeks later at whatever the price is and whatever the premium is at that point. So they're playing this hedging game. So there's a lot of intricacies that are working here, and that's why the Tax Act of 2017, Trump's Tax Act, damaged this market greatly, because you don't have the ability to do a 1031 swap anymore. 1031 exchange, where I could sell my Silver Eagles and buy a 1,000-ounce bar and pocket this massive premium, because I have to pay taxes on that entire swap. It's not a like kind exchange anymore. It doesn't get that tax treatment. So these are the things that I try to show the weaknesses in the system, and that's why we're having these systemic problems.
Bob, I was going to ask, somebody like Stefan Gleason is working on repealing that tax act, or do you know if there's any work being done towards that area?
On the federal side, good luck. I've worked with Stefan on I've in Idaho, for example, I went in front of the state legislature twice. On the House side, we were able to get a bill out of the House these last 2 years to try and get just the state of Idaho, allowing the state of Idaho's treasurer the ability to just put gold and silver on the books, where the laws where they have they can consider it an asset, not actually force them to buy gold and silver, but just consider it as an option. And in both instances, the bill was completely shot down when it got to the Senate side. In fact, it never even went to the committee chair, never even listened to it. She was like, I'm not even going to listen to that bill, and stonewalled it twice. And the funny thing is, Idaho is a big mining state. They don't even want to support their own industry. I mean, that's how idiotic this whole political process is.
Do you have any idea why that was? Why she didn't even want to?
Well, I mean, you have, for some people, it's not on the top of their priority. It's why I say, we're never really going to see confiscation in this country. Politicians don't look at gold the same way they may have looked at it 60 years ago. It's been generationally educated right out of the system. We all look at debt as money nowadays, not commodities as money. And that's why I think you're going to see this shift back from debt as money back to commodity as money, because if you can't get the commodities, what's your dollar bill worth? What's the debt actually worth? And that's why I kind of agree with like Luke Roman and a number of other guys out there that said you can only push this so far before you have to inflate, first of all, because there's no other way to service the debt. But number two is, if the dollar strengthens too much, the dollar going down is the release valve for this whole mess. But if it strengthens, that's going to be less dollars out there with the ability to pay back that debt, and that's going to be deflationary big time. And you can't have that, because then you're going to kill commerce. I mean, you look at that's why I say you look at the trade deficits, falling like a rock right now with the dollar going straight to the moon. Feels like that's not going to get any better if the dollar continues to strengthen, because our products are going to become more expensive. But yeah, the political process, there is no impetus to, even in a mining state, you can't even get a state legislature to be agreeable to even allow gold and silver as an asset to be invested for municipalities as the state of Idaho's treasurer manages municipalities' funds. I mean, right now, the state of Idaho, the only thing allowed by the state treasurer to invest on behalf of the municipalities is debt, short-term debt instruments. That's it. And they're getting killed on inflation. And that was our big argument for the last 2 years is, the state may not be seeing the nominal effects of inflation, but their purchasing power is getting crushed. And if they're not willing to do anything about it, you got to protect yourself. I mean, you got to create your own gold standard. I keep saying that. I mean, it only makes sense.
Hey, real quick, guys, if I could, going back to what Chris had said, in that, I guess when the banks had come in sort of as the rescue net last time, with the liquidity, I guess, they're making loans into the system. This time around, he was saying, we don't know 50-50 whether they're going to show up or not. Demand for those loans is what's going to drive everything. And if there's basically a change in, the best way I can explain it is like lifestyle or what's important to you, so to speak, and debt isn't one of those things, we've got a big problem, wouldn't you say?
Yeah, I mean, the problem with the loan structure is the banks have saddled a lot of U.S. Treasury debt. They've been actually sellers of U.S. Treasury debt. They've been sellers of corporate debt, trying to reduce the leverage on their books. And Basel III kind of adds to that pressure. But you're right. If there isn't the need for demand for that, if there's uncertainty that's building in the system, and all of a sudden as a small business owner, you go, I don't know if I'm going to build out the back of my building and expand my operation and take on more employees, because I don't know what's going to happen 6 or months from now or a year from now. You're right. I mean, just the demand for that is going to go down. But then if you have tight money conditions and interest rates start to rise, the cost of that debt, which we haven't really experienced, starts to rise, and it rises on a much higher marginal basis because we're coming from a much lower interest rate environment. It's like the U.S. Treasury going from 0.75% to 3% has been one of the worst bond markets in history in price, and that's not even and the banks don't even reflect that on their books.
Yeah, it's getting bizarre for sure. The whole reverse repo thing just scares the crap out of me. Nobody will tell anybody what's really going on, right? We just have to accept it. Just like the data that we have to accept every day as fact. Okay. Well, I go like the silver thing, right? The Silver Institute folks, not that they're all bad, okay, but there's some folks in there that are questionable. I've done a lot of research on them and a few other organizations, and you find some bad players here and there, and then you see that they're still kind of out in the business and still doing things. And it kind of, as a blue collar guy, just trying to friggin', make the bills every month, it's really discouraging. But listen, I'm going to cut it off, and I want to say thanks to you both for hosting this, and have a great weekend, guys.
I appreciate it. Thank you.
Thanks, Scotty. Appreciate your time, man. Well, Bob, I think maybe we can end it there for now, unless you have anything else to add.
Yeah. One thing I was going to mention is watch for next week. I think the wholesalers, depending on how demand kind of shakes out here, because in a sense, the supply and demand destruction that you see with price also can be measured in the physical precious metals market directly as well. So with price coming down and demand maybe getting shaken up here a little bit, you have retail that's been saying, oh my God, I bought at 23. I thought it was low, 22 is low. And now it's at here. I'm not going to add any more right now. I think it's important to kind of watch how the wholesalers react next week. If they maybe lowered the premiums a little bit, maybe especially on 1 ounce product, because that's been the most expensive. But that'll give you some indications. And I will be the first to kind of be out there to kind of mention, hey, this is what I'm seeing. The problem is getting that information from a retail dealer. They don't have any. There's no motive for them to say, hey, listen, we're going to lower our premiums, because some of these dealers, bought product maybe 4 weeks ago that are finally getting delivery of it now, but they bought it when silver was at 24.5 and they paid a premium for it. Now they're kind of underwater if they didn't hedge. So now they can't afford to have premiums come down. So Scotty was saying, you don't know who to trust. And then they're going to come out, you got to ignore the sort of the hype and the system's going to break and fall apart, because we could be due for a counter trend rally in the stock market. It's one of the things I put out yesterday, that the sentiment was so bad on that fear gauge index on CNN. You're due for some kind of counter trend move, and that in essence could also be a counter trend move for the dollar as well as the metal. So you could see this, whatever was going on the last 3 weeks, get unwound a bit, and so the metals start to build back up a little bit here, and the dollar maybe come off a little bit. If that doesn't happen and we start going down off of a massively oversold condition, that's when you have the makings of a crash. Where the markets, the sentiment's already down to an extreme level, and then all of a sudden people say, you know what, I don't ever want to see a stock again in my life, and they capitulate, and that's when it typically crashes happen. So, next week will be kind of interesting to watch.
Tom, could I have a final thought here?
Of course.
Thank you very much. Can I offer that in the last 18 days, silver has dropped approximately $6 in 17 of those 18 days. And today we had a nice day up, 35 cents up today. It's not a big, huge rally. But my thought is to everybody listening is that if you take $6 out of the silver market, it has dropped the price effectively $6, but it lets you buy more for your $1,000 or $2,000 or $3,000. But it's also taken $6 of price risk out of the market that should actually, if you understand it, it should make you a little more comfortable or a little bit more apt to maybe add to what you have or to start if you haven't bought any. That's my opinion. Thank you.
Yeah, it should make it more attractive.
There's an old there's an old saying in our business. If you like it at 26, you'll love it at 21.
You should love it. You should find it more attractive. Tweeter, did you have a question?
Anybody follow a small little junior Argonaut Gold?
I don't. I don't really follow the individual mining stocks. Even though I manage a hedge fund, the fund I manage, it's 99% invested in physical metals, and only a very small fraction of it. The mining companies I have is just GDX and GDXJ, so it's more just kind of keep that in front of on my screen, just so I'm kind of watching it.
Yeah, that's the smart way to do it. All right, guys, have a great weekend. Enjoyed it.
Sure. Thank
Thanks
you.
very much, Tweeter. Anybody else have anything to add before we wrap up for this Friday?
Hey, real quick, Tom, just sorry, I don't want to keep everybody, but real quick on the savings end and the whole 2 ounces a month thing, right? So think about this for a second, and I may be completely wrong, but if it starts to catch momentum, right, and people are starting to put away that 2 ounces a month, right, that's in savings. As you build and there's more demand, you're going to support the price in the market. Your savings will grow as the price rises, right? Your purchasing power will rise as demand keeps creating as that 2 ounce a month goes. You can always exchange it back for services, goods, and your dollars or yen, euro, whatever. But just the thinking on that, the 2 ounce a month thing, if we can get it going, I'm telling you, we can change a hell of a lot of shit. Guys, have a great weekend. Take care.
Point taken there, Scotty. And the other thing I think that I guess we need to think about is, how do we begin educating people that aren't interested in gold and silver to start doing that, right? How do we make that appeal to those people that haven't thought about that?
Yeah, it's important. That's one of the reasons why I like the idea of you have to have, and maybe it's a small business thing. Maybe it's guys like me that are have these depositories that maybe have more forward look into the markets. Maybe we're longer term oriented, but we're saying, hey, listen, if we can create these regional depositories where a merchant can then there's a marketplace, he knows what the price is, it's right in front of his screen. And maybe some of these digital players like Load or some of these other ones out there that that create the digital framework for they buy the 1,000-ounce bars or the metal, and that program's backed by it, but allows them to transact in a non-debt backed environment. But to me, the physical world has to lead. The physical world has to stand up and say, hey, listen, if I want to spend a silver round at a merchant, and the merchant collects these things, and the merchant has a way to distribute those or have those picked up by an armored carrier, or has a way to maybe ship them, and have the insurance and shipping all taken care of, or have it as minimal as possible. There's more impetus to go ahead and start accepting this stuff as money again, rather than relying on a digital framework, which is really backed, especially with the cryptos and so forth, is backed by basically nothing. I mean, it's backed by potentially a lot of non-audited balance sheets and leveraged tactics and a lot of marketers and promoters, that type of thing. So it's just weird how human behavior ultimately gravitates to hard assets, but it's usually the time when they gravitate to it is when there's peak uncertainty.
Yeah, good point. Anastasia, you have had your hand up for a bit here. Go ahead.
Yeah, actually, I was on before and I had some connection problems. Well, Bob knows that I talk about this a lot, but and I missed everything that you've been saying because I haven't been listening, so it's probably been brought up, but we're all sort of panicked. Well, I wouldn't say all because I can't speak for other people, but the people I know are panicking, what's going to happen with cash? What's going to happen with this digital dollar that we're hearing about? What's going to happen if we have, 300,000 in a bank account and the banks collapse and they just take our money? And then, so you buy 100-ounce silver bars or gold and you stash them somewhere. And then how are you going to buy groceries with that? And then there's this crypto crash that's going on. And, but Bitcoin is something you really have to learn about. You have to figure out the wallet that you need and, how to protect it. And so I'm sure that you've talked about this subject, but when you have a bunch of gold and silver sitting somewhere, I'm sure everybody thinks about that. Have you covered this topic and I missed it, Bob?
No, I mean, we could touch on it because that's the uncertainty of the markets that we're in right now. Is everyone thought crypto was going to be the place to be, and it may be. I mean, who knows? I mean, it may be. There's a lot of guys out there that are trying to create the digital version of gold and silver, and using metals backed where say someone doesn't really want to take delivery of a product, but they just want to be able to spend it and have their purchasing power protected somehow. And there's and that in that realm, I think there's a great service for that. Especially if a guy like me that knows how to move metal off the exchange, and if you're looking for 1,000-ounce bars and you're trying to create a program, and you're like, listen, if we got a sort of a kind of like a Bitcoin type of thing, but you create it in a digital version, but it's wrapped around an actual physical asset, and that physical asset has a good solid two-way market to it, and so if people start spending their money at will, and then you have to sell those 1,000-ounce bars back to the market, or if you need liquidity and you need to buy, you can create an environment that starts to feed on itself, kind of like what Scotty was saying. And that's what the public needs to do. But the public won't do that until they have disbelief in the dollar or in the banking system, and they're not really too forward looking. It's typical when you see the retail crowd, everyone piles in on the stock market when it's near its highs. And that's of course when Wall Street wants to make it look as great as possible. That's when they wrap the market in a nice bow. But I think you're right. If there's more education out there and people aren't spending, 50% premiums to get a product, I think that would start to allow people to say, listen, silver makes a little bit more sense. And that's why I keep saying that the only way to really do that is to neutralize the premium by offering it in a more organized fashion, where you start to say, okay, if the spot price is going to be $21 an ounce, and maybe an Eagle's at $30 an ounce, because yes, there is a cost to produce it, there is a cost to transport it and insure it, and send it to Sunshine, make the blank, and then send that blank over to West Point, New York, and then stamp it and then package it and then have it distributed and then ship that back out. Those are real costs, and that should be in the cost of that product. And that's why the Mint sells Eagles at $2.95 over spot to distributors. Now, why distributors sell it at a higher price or retailers sell it at a higher price, that's a different ballgame altogether. But if you had a market environment that said, hey, listen, there's a national market and it's published prices, and the Silver Eagle's at $30 on the offer and it's $29.50 on the bid, there'll be a lot more people that are willing to pay $30 at that point, understanding that, hey, listen, there's a 50-cent spread. I can deal with that. I can turn around and sell it. It's not like I'm forced to sell it back to the same guy I bought it from, and he may only be bidding at $2 over spot, and all of a sudden I got this massive loss. That's what we need to see, and I would love to develop that in the marketplace. I've tried to reach out to tech guys, whether using crypto and NFTs because we looked at the idea of using NFTs as a way to back each individual, say, for example, serialized 1 ounce gold bar, for example. It's a unique bar because of its own serial number. You could tie it to one NFT token, and all of a sudden that NFT now can trade on an exchange. And then you have the token or the metal that's backed by it. So basically it's a commodity contract. It's not a security, but that's what those are the things that I've looked at and trying to talk to, legal firms and software developers and then, cause you have to understand the regulatory environment that you're in, could that become a security at some point? And all of a sudden you just violate security laws. And then now you're holding on to this token that's backed by silver and it's, been illegally sold into the marketplace. I mean, so there's uncertainty that you have to overcome, but that's what I'm looking forward to trying to raise. Not simply saying, hey, listen, the COMEX is it's corrupt. Let's figure out solutions to this problem rather than just continually point fingers.
I've been in gold and silver for about 20 years, and during my path of getting knowledge on gold and silver, they said that Woodrow Wilson had put in his memoir that he regretted signing a law of the Federal Reserve. And then somewhere down the line, I figured out that was a lie. So there's like a lot of disinformation in this learning curve. Also, there was, when people talk history about gold and Germany during the Weimar Republic, there were some people that are selling gold and silver saying you could buy a building for like 1 ounce of gold, and I'm not even sure if that's true or not. I still haven't figured that out. But I'd like to know if you have any knowledge of history with gold during inflationary times. Like I would think, like if gold goes up in value, let's say gold goes up to $20,000 an ounce, a house or a building is not going to remain at, let's say the average price of a house is $500,000. I doubt like a house is going to go down in value. Or they're saying if you raise interest rates, home prices go down. But if there's hyperinflation, like my aunt bought a house in Los Angeles in 1974 for about $45,000. The home prices have never gone down to that level ever since that time. So I want to know if the talk about Weimar, Germany, and you can buy a building for an ounce of gold is true. And before I let you go, I want to say that cryptos are basically gambling tokens.
Yeah, I've been told. I did a seminar a long time ago. I had a guy that came, and he actually had family that lived in Germany during that time, and he was telling me that you could have bought a home because the problem at that point is when currency goes worthless. I mean, there were people that were obviously, if you were a landlord, people were taking fixtures out of the home, using that as currency or as barter. So renting a home out wasn't necessarily the greatest thing in the world in a hyperinflationary environment because the renter could care less. He had mentioned to me that people were buying homes for 2 gold coins only because the currency was worthless. There's nothing to trade in, and it's all relative. I mean, I guess it's all who, if you're forced to sell, it's what someone else is willing to pay at the time. I know that the thing that I worry about in this environment is I don't think this generation of investors who grew up in the last 15 years in the markets, I'm saying not in the last, physically in the last 15 years, but been in the markets the last 10 years or so. They've lived in a world of basically money printing and asset inflation. They haven't seen a world of forced selling yet. And they've started to see that the last 3 or 4 weeks. You've seen, March of 2020, yes, there was forced selling, but you blink your eyes and a month later, prices are back up and going back in the same direction that they were going in previous. But seeing what we're seeing, the unwinding of these stable coins and the promises that all these utopian coins were basically sharing of the promised land and all this good stuff, that stuff blowing up, that has a psychological effect of trust and confidence. And that's what you look at as an evolution of hard assets becoming more and more important of someone's portfolio, because ultimately, as the markets continue onward, and let's just say we're in a bear market and you're trying to find the asset that works, and let's just say, silver, which is the only metal that hasn't hit a new high from 1980. It's the most. I was telling Tom before we started this is going to be like a therapy session, I think, for many people, because we're going to be like, God, I'm Bob. I haven't had a drink in 3 weeks or whatever. But it's like I'm a silver investor and I haven't seen the light of day in 10 years. That's the mentality. I think that it hasn't done anything. And the question is, if it starts to move and everyone says, well, God, you look at silver and the all-time high is $50 an ounce and it's only at 21, and how much more risk is in it? And if the price starts to rise a little bit and you start to get the momentum going, it may be the one asset that hasn't done anything, and that's a benefit, not a negative at that point. It hasn't had its big day in the sun yet. It hasn't had the hockey stick move, and I think that's what we're all looking for as investors is where is money going to flow to next? Is it going to be gold as sort of like, maybe not necessarily king of currencies like I mentioned with Lee, but maybe it becomes just a safe haven asset.
I was going to say, where's that asymmetrical risk profile that we can at least have some type of solace in thinking that we're not, like you said before, how exactly did you put that, Bob? Return of your money versus return on your money?
Yeah. I mean, it's the old Exeter's pyramid type of scenario where gold doesn't have anybody else's counterparty risk, and that's why it doesn't pay a yield, because there is no risk. And if you get into an environment like that, where all of a sudden people are, they get so petrified of risk and confidence, hard assets become. I mean, I've read stories where people were buying bedpans in Weimar Germany and trading them because there was more value in the bedpan than there was in the currency. Or going to dinner and the price of the meal is going up by the hour. I mean, there's some crazy stuff out there. But imagine, in a world we live in now where you can't even find baby food. I mean, and you see all these food processing facilities around the country burning down. You see some really crazy stuff going on.
But my question is, so the way, I mean, I'm kind of looking at it like trying to go far ahead. So, whatever the inflation rates, they're bringing it down, they're taking money away from the people. Then where do people move? Gold. So then bonds. So U.S. Treasuries, I don't know, let's say the 20-year notes or something. So, and gold has become, there's physical, like you sell, and then there's a ton of paper gold, right? They synthesize it. And then if it's real or not, who knows? There's conspiracy theories about that. My question is, we're the gold bugs. I like gold. I like physical gold. I don't know about this paper stuff. We're fighting against the U.S. government because they're going to want people to buy the treasury bonds to keep them up because they're going down. So they're going to synthetically try and drop that price. I like silver better because I think it's under the radar and has more utility. And it's just not a precious metal. Gold, I know, jewelry and stuff, but silver has more utilization. So that's why I like silver, and I'm not doing gold. I mean, I'm talking about synthetic or paper. Do you see that as an issue and do you see it ever decoupling? And will the paper gold just go to nothing and the physical gold go to everything at that point?
Well, I think the physical metal, at some point, I mean, there's reasons why central banks hold gold on their balance sheet, and the way I kind of look at it is that's their bread and butter, or that's their anchor of the portfolio. If everything goes to hell in a handbasket, at least they have some form of gold, and then at some point they're going to want gold to float higher as a higher percentage of their balance sheet. And the oddity about the euro is that the more the euro drops, the higher the gold pool that's in the euro becomes a higher percentage of the weighting of what makes up or backs the euro. To me, it makes more sense that ultimately gold gets reintroduced into the system under some type of hybrid type of pool, or people look at the SDR, the IMF's version of a basket of currencies, that type of thing. But I think when Powell was talking about we need to have potentially two stores of global reserve currencies, I don't think he was talking about the yuan and the dollar. I think, to me, it would make more sense to use gold because it's just a neutral reserve asset. And that's where I think it becomes more imperative. People start to see the value as gold is, hey, listen, it's not simply owned by a government or needed by to be denominated in a certain price because it's traded everywhere throughout the world. So it becomes much easier to use that as an underlying anchor to maybe back, like I was mentioning in previous spaces, use it to back the foreign owned debt of a foreign country. So the foreigners have more confidence that there's maybe something behind that debt besides just full faith and credit of the government. I guess the question is how far does the Fed try to push the markets or tighten markets to break something? And then what does that break look like?
I agree with that. Yeah. I just gold is a competing asset with the like 20-year treasury because they want people to buy their treasuries, U.S. versus gold. So I don't know if they'll try and sink it a little bit like through paper.
Well, and people have talked about gold as a zero coupon bond. I mean, it's the ultimate zero coupon bond in a way, but because it doesn't pay any type of interest. But I think gold is priced. There's a few different ways that people see value in gold. It's not just negative real rates of return. It's not just inflation. It's not just political uncertainty. It's also the counterparty risk. It's also the systemic risk. Narrative. If the paper starts to become, if the market becomes unwound, what good does owning a ETF or a futures contract if all of a sudden everybody is clamoring for the physical metal and you're standing for delivery and you're just standing around with your hands in your pockets? I mean, that instrument's not going to do you any good either. That's
right, and that's why I was asking. You think the paper will decouple from the physical?
Yes, I think at some point that's what this deleveraging is all about. That's why the banks have been backing out of the gold business. They've been, there are a number of banks that have closed their trading desks, that have sold their depositories. I mean, they've walked away from this business because I think, and that's why Basel III, I think, is trying to reduce the leverage that banks are taking on, and maybe gold is just one small portion of it, But I think in this environment, there's no way out. It's inflate or die, and I don't think and in that environment, we could become we could be getting into a more illiquid environment where you don't have like the nickel situation, or you have like palladium is a great example that
exactly. I mean, gold could shoot up like in an instant whenever that happens. It could be crazy, right? Because I mean, it's a huge amount of money on a level of metals, in my opinion.
Yeah, no, I mean, imagine someone wants to buy 50 million ounces of silver. They buy, of course, there's contract limits on the COMEX, but let's just say, like we saw 2020, the everything was running out and premiums were going up, and the best place to go to at that point was the COMEX, because the COMEX was not only the cheapest place in town, but you had just had 50 million ounces put onto the exchange because of the arbitrage that was happening between the massive contango between London and New York. So you got a lot of players, refiners, whoever it may be, that was just dumping metal onto the exchange and selling contracts against it and playing the role. But imagine if you're a guy that says, you know what, I'm going to buy this contract and I'm going to start requesting delivery. And now you got these players that are short, and maybe they're hedged using the futures contract against a physical position, and they don't want to give up their physical. Maybe that has commitments, or it's hypothecated, or it's already leased out. And so they have to buy back that short position. Well, in 2011, when you had that roll, you had a deleveraging there, but it was to the upside, where basically the shorts were squeezed, not the longs to the downside, but the shorts were squeezed to the upside, and there wasn't the liquidity to be able to roll out of that position. And you saw the same thing happen with gold in March of 2020, when prices got crushed. At first, you took the liquidity out of the market on the downside, so anybody who had sold was selling. So then all of a sudden the shorts, when they tried to cover, there was nobody left to buy from, because all those longs were out. And then all of a sudden the price skyrockets the opposite direction. That's why I think David Morgan put something out which was really good the other day. 2008, silver went from $20 to $8 or $20 to $9 an ounce, and then 2 years later it's at 50 because you've taken extreme measures on one side, deleveraged the market, and then all of a sudden, whether the leverage comes back or not, but you have buyers that come in, and there's nobody left to sell. They've been, that's why physical guys like me, we watch the market, and a lot of these price moves, especially in this environment with declining consumer sentiment, and you have the debt issues, and you have the you have the need. It's almost like national security that interest rates can't rise, because if they rise too much, it's going to snap something even more. But we're forced into this massive inflationary warp at some point, I mean, it's either that or, the debt just, the dollar screams higher and there's not enough dollars left to pay any debt left. And then what does the world look like at that point?
Anastasia, you had another question?
Yeah, sorry, I just had to go to the phone.
Okay.
I don't know if I got my question answered, but it's like, depending on your age, if you have like a bunch of gold or silver sitting somewhere, and is it an investment or is it just a safe place to keep your money? Because that's what I keep talking about is I think people are concerned about having the money sitting in a bank. If the bank should collapse somehow and they grab your money, because I don't know, there's just a lot of fear out there. And what's an investment, what's not? And also I want to talk about Bitcoin because I've been in a lot of these Bitcoin spaces, and the Bitcoiners, the staunch Bitcoiners, don't believe in the stable coins at all. The other coins, they just call them shit coins. It's only Bitcoin that you should be investing in. But that's not even an investment either. It's also safekeeping. People are thinking more about safekeeping their money, their cash, as opposed to investing. And if silver is the metal that's utilized more, which is what that gentleman was saying before, because they use it to make things, right? Why isn't it going up if that's the case? If it's in demand to make, I don't know what they make with it. They use it in making automobiles and stuff, right? And different things.
Lots of electronics.
It's also rarer than gold is, isn't it?
No. It's about 10, the natural gold to silver in the ground. There's about 10 more ounces of silver than 1 ounce of gold. I think that's between 8 and 12 is I think, as I've read, depending on the person and what they think. But I think that's the platinum is actually much rarer than gold is. I think it's for every 6 ounces of gold, there's 1 ounce of platinum in the ground. So if you look at from a rarity standpoint, platinum actually has more value right now. But the only thing more hated than silver is platinum. I kind of joke with that. But
which one would you look at more as an investment as opposed to safekeeping, gold or silver?
I look at, from a safekeeping standpoint, gold is more known as money or as some type of counterparty risk-free type of asset. It just has more tradition behind it. Even though silver's been money longer than gold has, silver, 60 or 70% of silver is used by industry, and it's the investment side, the investor side, that actually creates the ebb and flow of whether the price goes up or down, because that's the part of the curve that can add more demand at the margin and shoot that price up. So silver I look at more as an investment, and gold would be more of a store of value, I guess you could say, because silver is just more volatile. It's just, even though there's more ounces above ground in silver, that's pulling out of the ground. Silver is just, it's because it's a lot less in value, it just gets pushed around more in the marketplace. It's not a bad thing. It's just that because of the liquidity factor and how much money's been created over the years, when players get in and out of these smaller markets, it tends to have that much bigger of an effect. And that's why a lot of people, like David Morgan would say, 90% of the move comes in the last 10% of the time with silver, because when it does fly, it goes up like a hockey stick. It's just waiting for that moment to happen. Just like, watching nickel or any of these commodities. Commodities typically, when they start to move, it's more because of a short squeeze pushing the commodity up. People that were betting against it, maybe on a secular basis, or hedgers that, maybe hedging production, that you get into a situation where maybe they can't access that production, and now they have to buy back their hedge at whatever cost, and that creates that spike in price. And that's why, to me, that's what differentiates the two. I mean, in reality, silver is probably more usable as money, on a day-to-day basis, just because it's a smaller unit of account. But it's, at least that's the way I kind of see it, only because it's, silver is used in solar panels. It's used in medicine because of its antimicrobial properties. It's, I mean, electronics, like Tom was mentioning, it's most reflective metal. It's the most conductive metal as well. I mean, it has a lot of properties that just can't simply be reproduced or substituted as effective.
There's a lot of demands for it. For example, like photography, that over time have really dropped off, but yet have been supplanted by solar panel manufacturing, more electronics, things like that, that has picked up that industrial demand for silver as well. And just kind of back to your point, Anastasia, about, I think the way we think about different asset classes, you're talking about investment versus, maybe a better word would be speculation. I think speculation is you're looking for a major return on your money, versus an investment, you're maybe looking at wanting a real store of value. I think it's interesting, let's say the differentiation between Bitcoin and all of the other cryptos, where there's thousands of other cryptos that can just come to market at any point. That doesn't mean that just because they have a white paper that is attractive, that means that they're going to be worth anything, 12, 24 months from now. But, I think going back to that idea of really thinking about what has stood the test of time, and really being deliberate about how you break your portfolio down, of having, percentages held in different types of assets that are a store of value versus trying to maximize profit, I think is a great way to, I guess, again, be more deliberate about how you're separating things apart like that.
Thank you. I just have another quick question that I want to let other people have a chance to ask a question. I've heard about these gold-backed IRAs and 401ks and all of this. What exactly are those, and are they worth investing in?
The self-directed IRAs, that's where you can work with a self-directed IRA custodian. Typically, not your Charles Schwab or your Fidelity. It's more of a specialty type of IRA custodian that allows for alternative assets, like precious metals, real estate, other types of contracts or currencies, whatever it may be. But it allows you to establish an IRA, buy the physical metals with a dealer, choose your depository where you want to store them, because they can't be held on person. They have to be held at arm's length. So they have to be where you don't have custody and control of it. But you're basically storing it where the IRA custodian is. Yeah, it just like your normal IRA with buying stocks or bonds or a CD in an IRA here. You're just using gold, and the IRA custodian works as the trustee on your behalf to oversee your asset for you. So it's very similar to buying stocks in an IRA at a brokerage account, except you're just buying physical metals and storing it. We do a lot of that here, where we work with some of the number of different IRA custodians. Where the client, for instance, they may buy metals through me. We store the metals, but we store it on a segregated basis. We give them a report, the pictures, all that good stuff. And that way they can, at some point down the road, the advantage of buying a physical metal IRA is that you can, when it comes time for distribution, let's say you hit 59.5, or you have to minimum distributions of past age 70. When you take the distribution, let's say you don't want cash, let's just say you want the physical metal, you can take what they call an in-kind distribution instead of a cash distribution, and you can just take out the value of the metal instead of the cash. So you can take the physical metal, let's say gold's at $2,500 an ounce, you take out 1 ounce. The IRA custodian is going to report to the government, you took out $2,500 in value, so they tax you on $2,500, but they're not going to tell the government what actual asset you actually took. They're just going to report the value, so you pay taxes on that value.
Okay, I heard something about one where you don't pay taxes or your capital gains tax?
Yeah. What happens in IRAs is that your tax is basically deferred. You don't actually you can buy and sell and take the gain on an asset and reinvest that gain in another asset, but you don't have any tax ramifications because it's held what they call in a qualified account. So in that type of fashion, you can grow your assets over time in an IRA and recognize gains, but don't have any taxable event. The only time you would have a taxable event is when you start taking distributions out. If it's a traditional IRA, and at that point, those distributions are going to be taxed as income, not as capital gains. If that kind of helps. In a Roth setting, you don't get the upfront tax advantage, but when you take and you obviously check with your tax accountant or advisor, but when you take distributions out as a Roth, it's not taxed. But those are two separate different IRAs, and their tax treatment is different when you put the money in versus when you take the money out.
Thanks, Bob.
Sure.
All right, Bob, maybe we'll wrap it up there for today. I really appreciate your time. Jim, everybody for their questions, and of course, Lee for joining us at past midnight his time. So that was awesome to be able to have him and get his perspective.
Definitely. Yeah. I think everyone should follow him. Lee does a great job of, trying to remove the speculation and sort of the thought process and just trying to just grind the numbers and try to follow the trend. He does a wonderful job with that. I have a lot of respect for him. And it's a difficult thing to do because it's so easy to get an opinion on the market. And it happens to all of us. We're all trying to, try to guess ahead where this market's going, or what the politics look like and that type of thing. When you try to just stick with the numbers, and that's what I try to do with the general markets or with gold and silver. I try not to look at, the conspiracy side as much. I try to understand the COMEX, try to understand how the industry works, and relay that to clients so that I can explain why moves happen the way they do. It's not because there's some nefarious character that's out there trying to, constantly push the price down. Sometimes it just simply is someone was caught on the wrong side of the market and they got liquidated, and that had a big impact on the price. And it's just, and of course there's all other times, obviously, there is nefarious acts like spoofing and some of the things that, JP Morgan, has actually been gone after and settled with. So, but you just try to keep an even kill for your clients, and you just try to be educational and try to support what they're trying to accomplish, and then try to help in with pricing and support on that as well.
Absolutely, Bob. And I really appreciate having you be so generous with your time and always being willing to have these conversations and educate. I think out of everybody that I've done interviews with, you and I have probably spent the most amount of time approaching different subjects and speaking. So I'm always very grateful for your time and your perspective in the market.
Sure. I appreciate it, Tom. Thank you. And I appreciate the opportunity as well. And, I hopefully, we continue this and bringing, more astute market followers and strategists and other individuals where the community can kind of learn and they can, they don't have to rely on disinformation or misinformation. They can try and make that decision for themselves. That's what it's all about.
Absolutely. And next week, I'm just going through setting up, getting Steve St. Angelo on for a space for a couple hours as well. So he's, of course, really well known for his the theory on the energy cliff and how that is going to affect markets and economies. So that'll be good one to look forward to as well.
Yeah, no, definitely. I look forward to that because I definitely have a lot of respect. When he seems extremely knowledgeable about a number of those topics, and I think it adds a little bit more reasoning to why physical metal has a lot more value down the road than a lot of people infer. To me, that's why we're not near a top at all. I mean, you haven't had the public open their arms up and say, listen, I'm buying with everything. You know, we're very, very far away from that. You know, the silver squeeze got people hyped up, but I think hopefully people have learned that, you know, you don't necessarily trust everything your dealer says, you know, and hopefully we learn from that and become smarter, you know, able to become a better educated consumer, you know, be more targeted on what we purchase. That, to me, that's part of the investing process, you know, trying to avoid the mistakes and capitalize on the gains. So.
Absolutely. And I think that just reinforces not necessarily just the importance of the metals and that store of value that they hopefully end up serving us with, but also the importance of just commodities and energy in general, right?
Yeah. Yeah. Eventually, you know, we see a lot of these charts with you know, commodities relative to the S&P 500, you know, being extremely undervalued. And we also go, well, how's that chart going to invert or get back to where commodities now are overvalued compared to the S&P 500 or paper assets? And it's a process. It doesn't happen overnight. And you know, like Steve will probably show with his energy work and so forth, that these are the reasons of how that starts to transpire. There's a step-by-step process and an evolution, and there's a distrust of paper assets, and there's the worry over the economy and the ability to repay debt, and the people being sort of fleeced by their savings, you know, with the zero interest rates, and trying to say, listen, I don't know where to go anymore because the S&P was, you know, a lot of stocks were very overpriced and overhyped. And yet the bond market was sitting at an all-time low at near 0% or even negative. I mean, having $17 trillion in negative yielding debt was insane. Yeah, and that's why the only way we're ever going to get back there is literally yield curve control. And what happens in yield curve control is, I would think the metals would go to the moon at that point because there is no value in the bond market anymore. But that's the nuclear option, I think, that ultimately, you know, that the last step they can maybe resort to is, you know, the ultimate form of money printing. And that's where, you know, if $30 trillion in debt, I don't think that's going to get paid off. And, you know, by owning physical metals, that's, you know, as a consumer and an investor, that's my way of saying, hey, that's my hedge. There's only one way to do it, and that's inflate it away. So.
Absolutely. All right, everyone. Thanks for your time, and I hope everybody has a great and a safe weekend.
Okay, thanks, Tom.
Get some rest after a brutal week, and look forward to see what next week has to hold for us.
Definitely round 2. Yep.
Yeah, absolutely. All right, Bob. Take care.
Thanks. Bye-bye.
Bye.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.